Intact. And Gap, we've got numbers there that pushed that share price up 13% after hours. Could we have a read across into apparel stocks, Guy?
We will watch with interest. We're about to find out. The Friday session is almost upon us. Here we go. It's time for the opening trade. These are the numbers that we are looking at. Remember, we've had disappointing retail sales data out of the UK as well, so the pound's a little softer, but not by much this morning. So the FTSE 100 rises. I'm not sure it's actually maybe got anything to do with the pound, but it's up by 0.3% of 1%. The FTSE 100 trading at 81.73. The Stock 600 is up by a similar amount this morning. We are rising there. The IBEX is up by a similar amount. Recently, we've been seeing very flat markets, so a little bit of a lift coming through here in Europe. The CAC's maybe got a little bit more to digest. The DAX a little less so, but the DAX, the SMI and the CAC remain close for the time being. We will bring you those numbers in a moment, Anna.
Yeah, really interesting dynamics happening in the Asia session and the extent to which they're passing through or not into Europe. We talked about the weakness in China, and that certainly has been a feature, particularly the latter half of the trading day over in China. But in terms of what that means for Europe, elsewhere we saw the Asian tech story looking quite positive, and some of that was to do with what we'd heard out of NVIDIA and the fact that NVIDIA ended in positive territory yesterday. So with all of that in mind, that's my long way of getting to the fact, Guy, that we've got technology stocks doing pretty well this morning. So technology up by 0.8%, and we've got some of the usual names within the tech space doing okay. So Infineon, ST Micro, ASML, all moving higher. Media also moving a little higher this morning. Informa and Universal Music Group, those kind of businesses moving higher. In fact, all sectors are in positive territory. So even though the driver of this slight positivity we're seeing in Europe, it remains a little elusive, it is having a bit of an impact this morning, Guy, on markets. We are higher across all of the sectors. Technology up by 0.8%.
Yeah. Thales appears to be the reason why the CAC 40 is not open yet. I don't see a price on that, so that is why we're not getting the French market delivering an opening. Every other stock, it seems, that we are seeing within the CAC 40 is open this morning. In terms of where the weight is elsewhere, technology seems to be up a little bit more than most, but as you say, there's no clear sense of direction in terms of what is happening here. So you've got SML, SAP, AstraZeneca, LVMH and Roche, Novartis, the main gainers in terms of the point story.
Yeah, it's been really interesting the last few days where the trading session for Europe in the morning seems to have been undermined by geopolitics. On a number of days, that's been the story. And then we've turned things around in the US session a little bit later, where the market has focused in on maybe some of the tech stories or some of the earnings stories instead. And today we don't have that geopolitical concern, so it seems to set today apart from what we've seen the rest of the week.
I think we probably do have the geopolitical concern. We just haven't any new news on it.
Exactly.
To terrify us into maybe taking action when it comes to what is happening with these stock markets. Goldman Sachs cutting its expectation for the Stock 600 earlier this week, citing tepid economic backdrops across the continent, modest profit growth and share valuations close to their long-term average. European stocks have, of course, retreated since Donald Trump's presidential win, while the euro has skidded towards parity. We're not quite at parity yet. We're kind of 104. We're below 105, which I think is a significant line in the sand. Beata Manthi is head of European equity strategy at Citi. How are you feeling about European stocks right now?
Good morning. Well, Europe has been definitely in the epicenter of the storm for quite some time, right? So I see huge amounts of bearishness and negative sentiment, both from the analysts' forecast perspective, recessionary level of downgrades that really doesn't happen outside recessions. And that has happened because underneath the surface, many sectors, many cyclical sectors, tech, luxury goods, autos, commodities, have had meaningful 20 to 30% cuts to their EPS growth for this and next year. So, of course, the market has been underperforming. Then we got Trump win. It was the most obvious, the easiest negative Trump trade, just to add a bit more to the negativity. And what it resulted with is the most bearish relative futures position on Europe versus the US since actually 2018, when the first broader trade tensions erupted during the first Trump presidency. So this is where we are. Okay. Everybody's negative. Nobody wants to touch it. And the question is, what's going to happen next? And that's, of course, reflected in the underperformance of the index overall. And underneath the surface, even more on particular sectors, right? So that's the setup.
And are there things that have been oversold in that context then, Beata? Because, I mean, people might be attaching that discount to the whole continent, but not all of the stocks listed within the continent are equally exposed to it and its economic fortunes. So I wonder if things have been oversold.
So oversold, perhaps it's a big word. Within some individual names, I can't comment on absolutely. On the overall index level, on the relative basis, you see this gap opening up, like we have this what's priced in for EPS model.
But are there themes that maybe could look through
Anna really wants
the negativity? I'm really trying. It's Friday.
I'm all about the silver lining.
It's Friday and I'm dressed like a Christmas tree.
Let me tell you.
This is the positivity I'm channeling.
So from the negativity, I've mentioned this earnings revisions, the recessionary level of earnings revisions. Our models suggest that historically there is a bad and good news attached to this recessionary level of reading. The bad news is that next year's EPS, consensus analysts' EPS, is probably too high. So analysts are at +8, had +10 not so long ago. We have +5, so meaningfully lower. But the good news is that at this point of negativity, the market starts to see through this earnings weakness that has been already ongoing for quite some time in Europe. In the short term, not necessarily, like 3 months is a coin flip, but over 6 to 12 months' time, our model suggests that cyclicals tend to outperform defensives by on average 10%. So there could be better times ahead, but of course there are many moving pieces
The problem with the European story is that we keep thinking that all the bad news is in, and then we get more of it.
Absolutely, but we've already got a lot of bad news, right?
But it keeps coming.
Sure. At this level, you could assume that going forward, the news, the balance
Could I have made that argument 12 months ago, though?
12 months ago, the news was getting better. So no, you couldn't. Because everything has been improving, right? And there is a bit of déjà vu from last year. That's a good one, right? So everything looked gloomy. PMIs were dipping. And historically, when PMIs dip, we only know it with the hindsight, but that's again over the 6 to 12 months horizon, it is a good time to start averaging into cyclicality. So what we've done with our allocation from being in defensives and bearish over the summer came mid-September, we've started to average into cyclicality. We still have a bit of a barbell, but that's been the right way forward. So at least you need to close your shorts of the most underperforming parts of the market.
But how do you go about factoring in tariffs? And I'm thinking here about Trump's tariffs that people expect and the timing of those and the reaction that we are likely to see from Europe. How do you go about factoring in all of that?
So every single question you've asked about that concept is very difficult. There are many unknowns to answer it properly, right? So the timing, we won't know details for the next good few months, right? That's number one. Then how they are going to be applied. Is it going to be broad-based 10? The consensus is it's going to be difficult, right? Because if you really, being the US, if you put tariffs on everybody around the world, your economy is going to suffer from multiple shocks, while all the other parts that you put tariffs on, because there will be retaliation, right? Will get a shock, but lower shock, right? So, if anything, the US economy has more to lose from an open trade war with the rest of the world than the European one. But just to put things in numbers into context, our economists estimate that for the Eurozone overall, perhaps 20 basis points of the GDP. Germany could have a little bit more, of course. So this is where we are. of course, there'll be impact, but it's not going to be sharp, cutting off 1 to 2%, right? We are talking basis points.
Anna brings up Christmas, so let's talk a little bit more about Christmas. Is Donald Trump Santa Claus? Because the Christmas rally appears to have already been and gone. Is that it? Is Santa come early in the guise of Donald Trump?
Well, the Santa just came for the US, right?
Yeah.
I can't say that Santa came for the European market.
What are we going to get in Europe? So we talk about coal maybe in historical context.
So let's see if this bearishness of the sentiment, positioning and everything around us actually starts seeing improvements on particular parts. And it could come from many places, more from China, a lot of negativity and doubt that this will come. A lot more from administration and who is going to put in charge of the important polls and saying actually the 10%er is negotiable. But also more news flow from the European Union level in terms of what they are going to do to prop up the economy, right? The ECB has already turned to the economy favor. We thought they would go cutting every quarter next year, and now we think they will go at every single meeting to around September. So you're already starting to have more positivity there. Well, let's see what comes with PMIs. Of course, they are expected to be very low, but what I've noticed, they are low, of course. But the last 2 months, they kept beating expectations, right?
Okay.
So that's what the market notices.
We will look to see if we get that silver lining. We're going to get those French PMIs in around 5 minutes' time, aren't we? And then the German ones in around 20 minutes. You mentioned China, so just to linger on that, Beata, is that something that could provide a cyclical uplift for Europe? Or is this more of a... Are we structurally going to witness a different relationship between China and Europe?
So... Again, many moving parts there, right? From the economic perspective, it's more obvious that there will be tariffs on China than there will be broader tariffs for the rest of the world. And tariffs on China will have a negative GDP impact on China. So we need to see what is the response function going to be from China. So we think that on Eurozone GDP, the squeeze on China via tariffs could have an additional 10 basis points negative impact on the GDP. Now, in terms of EPS, it's a bit different story, right? Because the biggest downgrades and cuts to EPS this year have come through sectors and names with the biggest exposure to China. So what we need to start first is positive deltas from very low levels. And this is plausible to imagine.
Stock 600... 505 right now. That's where it's trading. Where do you think it finishes next year? Up or down?
With what we have right now, my forecast suggests up. I don't have the year-end forecast for next year yet.
That's what I'm hoping you were just going to kind of give us a little hint at.
The direction.
You think higher?
The question is the
magnitude.
How much, yes, and it could be volatile, right?
Yep. We're going into a Trump presidency. I think volatility is probably assumed at this point. It's always nice to see you. Thank you very much indeed. We'll look forward to your year-end forecast. I'm sure it'll be coming shortly. Beata Manthi, Head of European Equity Strategy, joining us from Citi. The Core 6 looks like this. This is how we are trading this morning. Europe's actually reasonably on the front foot this morning. Actually, some positive numbers are being posted. ASML in particular, as you can see, rising quite nicely. Thales is under a little bit of pressure. It's not on this board, but it is under a little bit of pressure. Let's get some details as to what is happening, more specifically in the French market. Here's Joe.
So we've got another mover over in France today. This is Nexans. This is the big French energy company. We got a book building on this, a share sale last night after the close of trading. And it is actually Chile's richest family selling a big stake in this stock, according to our reporters. They're selling around $250 million worth when converted into dollars. It's the Luxic family over in Chile offloading some of those shares after a big rally in the stock over in France for that one. Then we will switch over and look at that move that we had in Thales. It was a delayed open on that one. We saw a bit of a trading halt into the open in Paris. We've got that price now down 4%, facing a corruption probe in both the UK and France. Bear in mind, they do say they are complying with the probe and do stick to all regulations, but it relates to a deal over in Asia and potentially influencing a public official, is a statement from the UK and French authorities on that one. Then in terms of the Spanish banks, a bit of a mixed view on these ones today. Pretty much unchanged on Santander, BBVA slightly higher, and not too much action in the others. Remember, Spain raising its windfall levy up to 7% from below 5%, but some of that broke just at the cusp of trading yesterday, and we haven't got too much reaction yet, so we'll keep an eye on those. Over in apparel, remember Gap soaring around 16%. I'm still gutted they closed all their UK stores for Gap. I used to love shopping in there, but anyway, we have got H&M gaining a bit, potentially a bit of a move on that one. Inditex up 0.7%. They do have US exposure. GlaxoSmithKline, meanwhile, has a vaccine approved over in Japan for respiratory viruses. That's between people aged 50 and 59. It was already sold to people over 60. So that's a positive for GlaxoSmithKline's earnings for them. And then finally, the rating that got me exciting today was Porsche, because Citi saying you should be buying this stock after a 10% drop in the past 4 days as the company held meetings with investors, which spurred downgrades to earnings guidance. €85 price target, Porsche edging very slightly higher today.
Thank you very much. Joe Easton joining us there with a look at some of those stocks that are on the move. We are waiting for the French data then, French PMI data due out, Guy, and we were just hearing from Beata Manthi. You know, if you're looking, she was hoping that we might see a similar pattern to previously, where these numbers have beaten expectations, even if they're at low levels, but we'll have to see if that's what we get. We are expecting all of these numbers to start with a 4, and they still do. So let's go through these. We've got the composite number has come in at 44.8. That is well below the 48.3 expected. The services number has really dropped. That is down at 45.7 against an expectation of 49, and the manufacturing picture still bumps along the bottom at 43. That again is below the expectation of 44. So we have not got numbers that have beaten expectation. We have got numbers that have come in weaker, and they signify contraction. They're all below 50, continue to be below 50, and increasingly so. And the euro responds negatively as a result, Guy.
Shocker. Those are really horrible numbers. Those are really, really horrible numbers. But given the political instability that we are seeing, I guess maybe against that backdrop, you would maybe expect this. We've got a budget that we're factoring into our thinking. All of that is coming through. So we need to begin that process. In terms of what we are looking at, I'll get the commentary up in just a moment once I've cleared the website's guidance and see what exactly is coming through from the release in a little bit more detail around it, but there's a lot of negativity here. This is not a beat.
Right. Then let's bring in somebody who knows these numbers inside out. Bloomberg's Zoe Schneeweiss joins us here on set and can take us through. I mean, they look horrible, Zoe. What more do we need to know?
Yes, these are quite atrocious numbers. If you remember, France in the summer did actually surprisingly well, and that was all thanks to services, thanks to those Olympic Games and Paralympic Games that did so incredibly well, and France had a great third quarter. We always knew the fourth quarter was going to be painful, but these numbers just do give you an idea how painful it might be. And services has been that area throughout Europe that is manufacturing has been bad for years now, but the services have always saved it, and it looks like services no longer giving that support.
Yeah, and we're waiting for the German number, and services has been an area of brightness there. But this suggests, in France at least, that we've seen a real deterioration on that story. Is this about geopolitical uncertainty, or do we have a sense of what this is about?
That certainly plays into it. We obviously have there's uncertainty over the whole situation in France itself. You mentioned the budget. They know Macron's Prime Minister Barnier does not have a majority in Parliament. Yeah. That is an issue. Overall, though, this is just one of those things. If then the geopolitics play in, we all know that Trump tariffs will likely come and will just be detrimental for Europe.
And we come back to this question of whether or not France can wait. Germany has decided it's going to go early on its elections. Can France really wait and have another 2 years, 18 months of this kind of political instability that we're seeing at the moment? This is the line that comes out of the statement. The level of incoming new work received by private sector businesses in France slipped deeper into decline in November. New orders shrank by the greatest margin in exactly 4 years, amid a broad-based deterioration in sales performances at the industry level. These are the worst numbers in a really long time. Yeah. The situation is not improving in any shape or form in terms of this data.
And the French government wants a better French economy so that it can deliver on some of the tough choices that it needs to make. But is there a danger that the tough choices around the budget and around pullback in spending, is that a factor here, Zoe?
any element of uncertainty is harmful for companies. They're missing investment. There is this whole idea that Europe should be investing more. And there actually was a joint op-ed from the French and German central bank chiefs in Frankfurter Allgemeine Zeitung and Le Monde overnight, where they said Europe needs to get its act together. But governments just seem to be thinking quite nationally focused and not on how a joint Europe program could actually help all of them.
Yeah, what they're not saying is more debt. What they're saying is structural reform is required. We need less red tape. We need more investment. We need those kinds of things to get Europe going. French companies anticipate the contraction trend in activity to carry on to 2025. For the first time since 2020, May 20, expectations for output level in the next 12 months were pessimistic. The outlook is getting worse here in Europe. Am I correct in the kind of feeling in trying to aggregate all of what we're learning in Europe at the moment, that actually we're not stabilizing at a low level, we're continuing to deteriorate?
That's very much the case, and that's the one thing the ECB also is worried about, because if the growth deteriorates too much, that will obviously impact inflation, and there's the danger here that inflation then actually quite severely undershoots the ECB's 2% target, and that's something we'll be watching when Christine Lagarde starts speaking in about 10 minutes.
Yes, she's going to be speaking very soon, isn't she? And we...
I think she's actually speaking now.
Well, let's wait and see. Oh, she's welcoming people, I think, so we'll see what we get from her. I mean, 50, this was the conversation yesterday. We had various central bank governors speaking yesterday, and maybe the cuts are going to come faster than the market had expected, or maybe they come bigger than the market expected. Zoe, what are we hearing?
That's the issue. Most of them, and even like some a quite dovish governing council member like Yanis Stounaras, who was on Bloomberg TV yesterday, was saying his base case is 25. Obviously, if there's a deterioration in growth, they might recalibrate. It'll be interesting to see how the German and then the euro area numbers, for PMI numbers, that come out later will affect
the sense is, though, and Stounaras to a certain extent reflecting this as well, is that there's so much we don't know.
Yes.
We don't know at this point what Trump is going to deliver. We don't know what the response out of the European Commission is going to look like. We don't know so much, so therefore the potential for a policy mistake at this point, say it were to be 50, is greater. Is the ECB therefore hemmed in at this moment, constrained in its ability to act because of the uncertainties that exist at the moment? Those tariffs, that tariff narrative could be inflationary. The ECB just doesn't know at this point.
You're very right there. There is the issue that until Trump's in office, I wouldn't expect any change from that 25 basis point cutting pace that the ECB has put on display. I am curious, though, how markets are repricing after these French data, and we'll see what the German and euro area
the euro's dropped, but it stopped dropping. It's still in positive territory, so maybe it's waiting for the German data as well. We'll see.
And then the Eurozone data, which comes a little bit later on as well. Christine Lagarde is speaking. Let's take a listen to what she has to say.
Free trade from all corners of the world. And as the most open of the major economies, Europe, we are more exposed to those trends than many others. I will call Capital Market Union from there on CMU, so it will spare you a little bit of my repetitive anthem. CMU lies exactly at the center of all these challenges, in my view. And it is key for making our economy more dynamic and technologically advanced. While banks, play an essential role in the European economy, we know that integrated capital markets are needed for financing, in particular, early-stage breakthrough innovation. And it is key for becoming more resilient in a fragmenting world economy. Capital markets, in our view, is the missing link for Europeans to turn their high savings, more on that later, into greater wealth, which will ultimately enable them to spend more and strengthen internal demand. My macro is coming back here. However, this growing urgency has not been matched with tangible progress towards CMU, in large part because its implementation remained very loosely defined. Since 2015, when we first started seriously talking about CMU, since 2015, there have been more than 55 regulatory proposals and no less than 50 non-legislative initiatives. But that breadth has come at the expense of depth. It has allowed CMU to be picked apart by national vested interests that see one or another initiative as a threat to their territory and some of their mandates. So if we are to achieve a conscience shift, in my view, we need to refocus. Exposing the core inefficiencies in the system, yes, and identifying a smaller number of initiatives with the highest possible return. And as I see it, the core problem of CMU is that the pipeline from savers to innovators is blocked at least at 3 key stages. And that's the reason why I called my speech, Follow the Money. I know it resonates with other things, but this is literally. So those 3 key stages are: number 1, entering; number 2, expanding; number 3, exiting. What do I mean by that? First, European savings are not entering capital markets in sufficient volumes because they are concentrated in low-yielding deposits. I'll come to those 3 in a moment, specifically. Second, when savings eventually reach the capital markets, they remain trapped in national silos and they're not expanding throughout the European community. Third, once savings have eventually been allocated by capital markets, they are not exiting towards innovative companies and sectors owing to an underdeveloped system for venture capital. So there are 3 blockages, bottlenecks if you will, that require different solutions, but they must be seen as a single problem because they are self-reinforcing. Fewer high-growth companies means lower equity valuations and liquidity in the European Union markets, and lower returns for savers. So in my remarks this morning, I will outline the key blockages I see in each area and present some proposals with great humility, because I'm sure that there are other ideas and proposals that are out there, and maybe they're much better than mine. But I think it's about time that we actually put chips on the table and consider them, rather than just have general views about the shortage that we have here in Europe. So let's talk first about entering the capital markets. Europeans have a high share of their income, about 13%, high share of that income is actually saved. And this is much more than the Americans. In 23, we, the Europeans, we saved about 13% of that income when the Americans were saving 8%. That's in 23, and that's pretty much a standard trend. But typically, Europeans favor low-risk, liquid saving products. In Europe, approximately 11.5 trillion is held in cash and deposits. I'm talking here about the stock. This is 1/3 of households' total financial assets. If you compare that with the United States situation, it's 10% for the US. So that has 2 main consequences for our economy. One, European households are much less wealthy than they could be. Since 2009, post-financial crisis, US household wealth has grown by around 3 times more than that of the European Union households. 3 times. Now, some of you will dissect that and will say, oh, it's all about some of the Magnificent Seven in which American households eventually have invested, and as a result of that, we have the difference. Not only. Second consequence, the flow of savings into capital markets is much lower than it could be. According to our analysis, if European households were to align their deposit to financial assets ratio with that of American households, a stock of up to 8 trillion euros could be redirected into long-term market-based investments. That's in stock, or a flow of 350 billion euros per year. So why are people not diversifying their assets? You probably have ideas about it, but I'll propose mine. One of the key issues is that retail investment in Europe is fragmented, opaque, and expensive. In many countries, investing is complex and intermediated by financial advisors that people do not always trust. 45% of consumers say that they are not confident that the advice they receive is primarily in their best interest. And if households do invest, they often do not get the best deal. Retail investors in Europe, in mutual funds, for example, pay almost 60% more in fees than their US counterparts. Many Europeans, therefore, end up investing in guaranteed saving accounts by default. But this is not in the DNA of Europeans because they would be more risk-averse. No. Because when markets are a bit more competitive and consumers can choose from a wide range of suitable investment products, behaviors do change. In the Netherlands, in Sweden, in Denmark, households manage their assets in a similar way to that of their US counterparts, holding only about 10 to 20% of their financial assets in liquid form. So if we are to unblock the entry stage of the pipeline, we need savers in Europe who have products that are accessible, transparent, and affordable. In my view, a European saving standard, a standardized EU-wide set of saving products, if you will, is one way and maybe a good way to achieve these goals. Without adding to the bureaucracy, I get that. But if properly designed and distributed, these products would be accessible, simple to understand, available everywhere, and offering a range of investment options. They should be transparent because they would be structured according to clear criteria such as diversification, fee structure, and portfolio composition. And they should be affordable because financial services providers would be able to offer EU-certified products with less red tape, while standardization would lead to more comparability and probably more competition. Both effects would probably bring down the fees. The attractiveness of the European standard should also be enhanced by harmonizing tax incentives across countries. And this does not belong to your community, it belongs to policymakers, and they should not be shy about that. They should be courageous. Then the market should decide where savings are directed, not the governments. But depending on the preference of savers, products would also be offered that would support European priorities such as financing innovation and the green transition. That's for the entering into the market. Let's just now look at the expanding throughout Europe. Because to truly unlock Europe's innovative potential, which exists, we need finance to flow where the best ideas are. And given the nature of digital technology and the impact that it will have, which often requires large upfront investment, we need those flows to be in large volumes. And the second stage of the pipeline, expanding throughout Europe, is also blocked. Second bottleneck. We observe that capital in Europe is either trapped within national borders or leaves to the United States. If we look at equities, for instance, more than 60% of households' investment in Europe takes place within their own country. And if you look at institutional investors, they invest much more in US markets than they do in the European Union. There are many reasons for this segmentation of European markets, but a key one is that our financial market infrastructure are extraordinarily fragmented. In 2023, bear with me, I'm not making a mistake on the number. In 2023, there were 295 trading venues in the European Union. 295. There were 14 central counterparties and 32 central securities depositories. I was going to bring a slide, but it's not done for the president of the ECB, so I did not. But I have a drawing that I will frame in the hope that within a few years it is a little less artistic. And that drawing includes the 295 and the 14 and the 32. And it makes for a beautiful drawing, but not a very simple sector to navigate. In the United States, there are only 2 securities clearing houses and 1 CSD. Now, many CCPs and CSDs belong to pan-European cross-border groups, but national exchanges remain largely separate, despite some technical synergies like consolidated order books. This fragmentation creates high transaction costs for cross-border trading, which, according to ECB analysis, increases home bias in how investors allocate their funds. That, in turn, leads to lower liquidity for investors, issuers, and stock exchanges. Compared with their EU counterparts, the average daily trading volume per company is 1.3 times higher for US large caps and 2 times higher for US mid caps. So, what is driving this fragmentation? Again, you will have ideas and views on this, but let me put out mine. The main issue is that legal frameworks within the EU are divergent, and all meaningful attempts at harmonizing are blocked again by vested interests, often of a national nature. And national authorities tend to exacerbate rather than reduce this problem. For instance, there are some member states that mandate the use of national CSDs for issuing securities under national law or for settling primary issuances of sovereign funds. This melange of different regimes and enforcing parties severely limits the ability of exchanges and CSDs to integrate their national platforms, even within cross-border groups. Although I know that there are some movements in that area, and I applaud them. Progress is being made, yes. Europe is moving towards a common consolidated tape, which will help reduce transaction cost. This tape could reduce trading costs by about 40 to 60% by increasing transparency between dealers and investors. But it will not address the fundamental problem, which is that our incremental approach focused on harmonizing a multitude of national law of different categories, which involve different ministries in different settings, simply either doesn't work or works way too slowly. Again, looking at the other side of the pond in the United States, legal convergence often does not come about through total harmonization of state-level laws, but rather through federal law being introduced or one state's law becoming dominant. For example, almost 80% of all US companies that held an initial public offering in 2022 were incorporated where? In Delaware. You know that. In Europe, we will not be able to make progress by promoting one country's legal system over another. And that is why I called for a European SEC in my speech last year, and I reiterate, and I believe very much that it could be transformative, and it could well be organized as a network of offices throughout the member states. We can be creative in that respect. But there are two main ways that we could achieve a change in method. Because alongside this goal, there are other options to pursue. It does not detract from the fact that a European SEC is a move forward that I believe will trigger a lot more. Because supervision moves initiatives. So one of those two other options would be to adopt a two-tier approach, as we have for competition enforcement in Europe, or for banking supervision, as you know well, with the SSM. Entities that meet certain criteria would automatically fall under EU jurisdiction and within a common Europe-wide legal framework, with cross-fertilization of the legal systems under the authority of one key entity. Another option would be to use the 28th regime, much talked about in both the Draghi and the Letta report. That could enable us to carve out a special legal framework in areas where progress has stalled. We would then have a separate EU legal regime that firms can opt into, sitting alongside the various national regimes. In my view, the most realistic approach probably involves some combination of all that I have just mentioned. For example, to bypass the cumbersome process of regulatory harmonization, we could envisage that 28th regime for issuers of securities. They would benefit from a unified corporate and securities law, facilitating cross-border placement, holding, and settlement. But such a regime, as attractive as it sounds, and as a bit of a cop-out from the difficulty of harmonization, would, in my view, be unlikely to work for supervision, as it could lead to inconsistent enforcement and misaligned incentives if entities choose their own supervisors under an opting-in system. So here, we could envisage a two-tier approach or a single but decentralized approach. Financial services providers that fulfill a set of criteria, such as size or cross-border activity, would fall under European supervision. A shift that I called for at this event last year, remember. National authorities would continue to supervise smaller national players. Close collaboration between the European securities and market authorities and national authorities would be essential for success and would maybe move us further, because this is not going to happen overnight. So much for expanding. Let's look at the exiting, and that will be my third and last set of propositions. Because even if we get capital moving more freely within Europe, we still need to ensure that it exits the financial system into innovative sectors and companies. That's the whole point. And this is the third stage of the pipeline, which is currently blocked as well. In highly innovative economies, there is typically an ecosystem of investors, angel investors, we'll start with the family, but it's then angel investors, venture capitalists, private equity funds, and that ecosystem channels funds to high growth startups, mostly through providing equity. And this ecosystem is much less developed in Europe than it is in the United States. VC investment is only around 1/3 of US levels of venture capital. The upshot is that innovative young firms struggle to grow in Europe, especially once they reach the scale-up phase, where larger funding rounds are needed. The median European VC-backed company receives around half as much funding as its US counterpart in the same sector of activity. And we are largely reliant on foreign venture capital to fund European innovation. More than 50%, 50, of late-stage investment in European tech comes from outside the European Union. Something wrong with that? No, we welcome, as an open economy, investment from all parts of the world. But if the EU tech entrepreneurs, and we have many of those, receive mostly outside funding, it creates an ecosystem of its own. It creates a path dependency. And these founders may ultimately decide to list to list and grow their businesses elsewhere, particularly in the US market. And this is what I would call the unintended exit. So what can we do to close that financing gap? Let me look at it from a demand and supply perspective. Fixing the demand side is key. There are too many barriers and bureaucratic hurdles for entrepreneurs in our single market, which means that there are fewer high-growth companies and VCs that want to finance them. If you look at the Letta or Draghi report on completion of the single market and improvement of our competitiveness, it is obvious and full of very, very clear examples. But we also need to work on the supply side. And since we are starting from a deficit position, we need to use all the flexibility we have within the European financial system to unlock funding for innovation. Let me propose 3 changes that could make a difference. I'll be short for each of the 3. First, given the natural alignment of investment horizon, our regulatory regime should allow long-term investors to contribute more to long-term growth. For example, European Union pension funds allocate just 0.02% of total assets to venture capitalists, compared with almost 2%, so 0.02 for us, 2% for US pension funds. And this percentage, don't forget, is applied to a much larger base in the United States. Over 140% of US GDP, compared with around 30% of European GDP. First proposition. Second, we should fully harness the potential of our public development banks, especially the European Investment Bank, to pool risks and crowd in private capital. Not cried out, cried in. Successful initiatives are already afoot. Last year, the European Investment Bank and 6 member states launched the European Tech Champions Initiative, a fund of funds aimed at channeling late-stage growth capital to promising European innovators. To date, the fund has mobilized 10 billion euros in public and private resources and supported 16 tech scale-ups. This is significant, considering that in 2023, European scale-ups received around 30 billion in venture capital. So a third. But more can be done to unlock the EIB's potential and enable us to catch up with our peers faster. In particular, the EIB should be allowed to use its resources more effectively and provide a wider variety of instruments to support breakthrough innovation, especially when it comes to supporting early-stage startups. I welcome those changes if they happen. Third proposal, we should explore how to support innovation not only through equity, but also through debt. While Europe should ultimately aspire to have quasi-US levels of VC investment, in the meantime, because it will not happen overnight, we need to make the most of our solid, reliable, bank-based system. Banks can play an even better role in financing innovation. One interesting development in Europe over the past decade that you have instrumented has been the rise of venture debt. Venture debt loans that provide liquidity to startups between equity funding rounds. In 2022, around 24 billion euros in venture debt was allocated. And that is up from only
ECB President Christine Lagarde speaking at the European Banking Congress in Frankfurt, talking a lot about Capital Markets Union. We will return to that theme in just a moment. But whilst she has been speaking, we've been dealing with some German news flow. We covered the French PMI data some half an hour ago, and then whilst she was speaking, we got the German data. Zoe Schneeweiss very kindly stayed with us to cover this, so let's get to that. Zoe, your thoughts on what we're hearing out of Germany then? So the French numbers came as quite a negative surprise for markets. They were very much into contraction territory. The bad news for Germany is that services, which had been a bright spot, now back below 50.
Yeah, that German services number is quite horrible. If you look at the longer data, services had been growing every month since March, and the last time it contracted was February. So now being back in contraction for services, which has been the one thing that has been saving Germany. As we know, Germany is very much a country about manufacturing. It's a strong export country. So the malaise that we've seen there, that manufacturing malaise, has been one of those haunting topics all year. And services has always been the area that saved them. So this is very bad news. And if I think about the election campaign that's going on right there, this is just one of those things that, again, will probably hurt the current government and, again, help the opposition and maybe those fringe parties.
Let me throw another fly in the ointment. The German data are bad, but the inflation number within it also is very bad as well, once you start digging into the details. Inflation is ticking higher. It's being driven by services, but it's input and output. We're seeing effectively a very clear demonstration of a stagflationary services sector economy in Germany. It's not producing the growth. We can see that at the headline number, but you've also got an inflationary tick higher, which is presumably going to concern the Bundesbank.
That will concern the Bundesbank. The Bundesbank is generally, if you think of it, Joachim Nagel, the Bundesbank chief, he regularly refers to inflation as the hungry beast. And he said actually earlier this month that hungry beast finally had been defeated. So these numbers will concern them. It does help explain, though, why the Bundesbank always takes such a hawkish stance. If inflation is, in fact, an issue in Germany, it's a reason to go slower maybe on those rate cuts. At the same time, if the growth is so bad, really that needs to feed through to inflation.
And the market has been pricing in more cuts as we've been digesting this data this morning, or at least yields coming down.
So yields have come down. We've got a 35 basis points now priced for December, i.e. we are above 25. So the market's beginning to put 50 on the table. We're not there yet, but we're creeping in that direction, which I think is interesting, because most of the central bankers I'm speaking to, we're hearing from, are saying we need to be cautious.
Exactly. The number they're waiting for is next week's inflation number.
Yep.
We get inflation data for November on Thursday, Friday next week, and those will be the numbers that probably let the ECB decide in the end.
So thank you very much indeed. Zoe Schneeweiss talking us through what's happening in terms of the data, and Christine Lagarde, who is still speaking, still on live go if you want to watch her conclusion. While we've also been speaking, Northvolt has announced that its CEO, Peter Carlson, is going to step down. This is the Swedish battery maker, files for bankruptcy, Chapter 11 in the United States. More to follow on that. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
I want to talk about what's happening with the European car industry. So within the last few minutes, we've learned that Northvolt's CEO is going to be stepping down. That doesn't come as much as a surprise, given the fact that this European battery company has filed for Chapter 11 over in the United States. Emblematic, you could argue, of the crisis that is gripping the auto sector on this continent. Craig Trudell joins us now, our autos editor. Craig, how can you build EVs if you can't build batteries?
I think ultimately the answer to that question is going to be we're going to have to rely on likely Chinese, maybe some Japanese and Korean companies to come into Europe and make them for Europe in the region. I think Northvolt was really sort of the best hope that Europe had for a sort of homegrown company that would be able to handle this. And the amount of investment that went into this company, the prominence of some of their backers, I mean, Volkswagen, Goldman Sachs, Bailey Gifford, BMW, there were a lot of blue chip names that piled into this company.
So this is an industry effort that's gone sideways rather than just one specific business.
Yeah, and government too. I mean, there was a whole lot of backing that went into this company. There were the CEO we should mention was a Tesla veteran. There were a lot of big names that sort of gave you reason to be optimistic about them being able to pull this off. But I think what we've seen is that China has really just, sort of stolen a march on the world in being able to scale up and get to a point where they have so much capacity, so much overcapacity, and that's something that you hear so much from the West is that they've driven prices so down that competition just cannot make it.
And we started with our program with the chart that showed just that. Craig, thank you so much for joining us, taking us through the story. Craig Trudell, talking about cars. Guy, I feel we have not provided very much that is of an uplifting nature this morning.
Let's talk more about cars. It's the Vegas Formula One this weekend. There you go. That's a nice little transition into the weekend. Something for Anna to watch this weekend. I know she's going to be absolutely glued. Ski season starts, so a number of the high resorts open this weekend. So Val Thorens.
Will there be snow?
So there's lots of snow. In fact, loads of snow.
It's cold here, so I'm assuming there is snow elsewhere.
In fact, it's snowing heavily. High winds are a bit of an issue, though. The Dolomites haven't had much yet, but the high resorts like Val Thorens are there.
And Las Vegas apparently looking forward to the F1. F1 fans spend 3 times more in Las Vegas than the average visitor. So I was reading from our Bloomberg Pursuits team. So those in Las Vegas watching the economy there will be in for something of a shock. That is it, I think, for this hour of the programme and for this programme for this week. Yes, indeed. We'll leave you with news that traders are now pricing in 150 basis points of ECB cuts in 2025. That kind of sums up the morning we've had, really, doesn't it, in terms of European data. That's been the direction of travel. That is it for the opening trade. The Pulse is up next. Have a good weekend, everybody. This is Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, You probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Hi, I'm Laurie Haynes, CEO and co-founder of Shirar, and I'm really excited to tell you that we are going to be raising funds for Shirar again. After a successful raise in 2023, it's time to scale.
We hope that you enjoy the pitch deck and the financial model. Any questions, please don't hesitate to ask us, and we can't wait for you to be part of Shirar.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
The forecast was 51.6. Cross asset, a lot of focus, of course, on Bitcoin. We're now flirting with 100,000, 98.845. Brent, 74.69. This is on these renewed tensions in the Middle East, but also Ukraine. And then the 10-year yield just below 4.4 at 4.3963. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Now, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President-elect Donald Trump is nominating the former Florida Attorney General Pam Bondi to run the U.S. Justice Department. Now, that's after his first pick, Matt Gaetz, withdrew from consideration. For more on this, let's bring in Bloomberg's EMEA News Director Roz Matheson. Roz, I don't know whether it means that Donald Trump is actually getting some pushback or whether it means that he thought that it'd be better to change candidate because Gaetz was so controversial that it would actually hurt the goodwill from senators.
Well, it's interesting to see that he did actually withdraw from contention late yesterday, citing what he said was the distraction around him for this nomination, because, of course, he's carrying a lot of baggage. He was, the subject of several investigations into alleged sexual misconduct allegations. He denied, but the noise on that was very intense, and also reports about the fact that his campaign has spent a lot of money on e-processing services through Stripe during their campaign in 2024. So part of that was just the intensity of the noise around him. But interesting to see, what we were hearing is that quite a few Senate Republicans were expressing concern around his nomination. So an early sign that not everyone in the Senate, Republicans included, may fall into line automatically on Donald Trump and his policies. But in a way, what he gets in place of Gates is someone who's a very experienced conservative lawyer. She's obviously a fierce ally of Donald Trump. I mean, she served on his defense during his first impeachment by the House in 2020. She's repeated his baseless claims around fraud in the 2020 election. She's also said on the many DOJ moves against Donald Trump that these are laced with politics. So she'll certainly be someone who will enact or try and enact his policies at the DOJ, but she does come without that political and legal baggage that Matt Gaetz was carrying.
And still no Treasury Secretary, Roz. Why is it taking so long?
Well, it's interesting to see on the Treasury Secretary, that's the one appointment we're still really waiting for. And there seems to be, a lot of jostling between contenders for it, but also slightly differing views in Trump's inner circle about who would be best placed to take that role. But obviously it's significant whoever does. We've seen, for example, Donald Trump still wading in on policy around, for example, the Federal Reserve, even though Jerome Powell has pushed back against that. So it's obviously going to be a really important appointment either way, and interesting it's taking so long. And it does show, again, that not everything is quite as automatic around Donald Trump as we thought. Yes, he's got a lot of his people in place already. He's nominating people who are close to him, who might have perhaps not really that much experience in the role that they're nominated for. But this one seems to be particularly tricky, and it's very interesting to see that.
Roz, thank you so much, as ever, for your insight. Roz Matheson there, Bloomberg's EMEA News Director. Now, we have a couple of things in terms of PMIs weaker than expected on both fronts. Services also now indicating a contraction, euro falling to the weakest level since 2022 against the U.S. dollar. So to talk about PMIs, but also the wider, of course, European economy, underneath this white area data, the contraction in Germany's private sector activity worsened in November. In France, activity plunged at the quickest rate since the start of the year. Now, in a moment, we'll speak to Goldman Sachs' Christian to get a sense of actually what happens next. And this, of course, is in a context also of possible trade wars and trade tariffs from the U.S. Now, let's bring in Zoe Schneeweiss, who heads up our Western Europe economy coverage. Zoe, thank you for joining us. I mean, it's not great, actually. If you look at the private sector, it kind of slipped in a contraction, and we were not expecting it.
Yes, those numbers are quite atrocious, really. And the issue here is that we've known for a while now that manufacturing is in trouble. But services also going below that vital line of 50 just shows that there are deeper problems here. And I'm not surprised in a way with Christine Lagarde today in this speech that says Europe needs to get its act together. Similarly, the central bank chiefs of France and Germany put out the joint op-ed saying, Europe, you're in a time of crisis. Please finally do something. But these numbers obviously are quite concerning.
But, Zoe, I mean, if you put this into context, and I know Christian will weigh in to try and figure out exactly what Europe can do in terms of competitiveness, but how difficult is it to try and get your act in order when you have looming tariffs or a possible trade war from the U.S.?
Those definitely don't help. A lot of the issues, though, are homemade. And if you look at those big two economies, France and Germany both have more than enough political issues right now as well. As we know, Macron did call those elections, now doesn't have a majority in parliament. Similarly, Scholz called early elections, is very likely to lose that top spot, probably not be chancellor anymore. So there is these homemade things, and then Europe does not have a united front in a way on what to do about Trump. They could have started planning on to Trump-proof, basically, Europe. They had 4 years to Trump-proof Europe, and they did very little. And it is, just watching this as a commentator, is quite depressing.
Zoe, thank you so much. Never mincing words. Our Zoe Schneeweiss, of course, looking in charge of our European economy coverage. Now, we're joined by Christian Müller-Gleesman, head of asset allocation research at Goldman Sachs. Christian, I mean, I don't know whether to start actually with the fact that Europe needs to get its act together, or we don't really know what the policies of the U.S. are, but so far the nominations are pretty rattling in terms of, blowing up the system.
Yeah, I mean, it's very clear they're increasing uncertainty. And it's not all because of the U.S. elections outcome. I think there's multiple things going on here. You have the trade policy uncertainty that has majorly spiked since the U.S. elections. And our economists actually found that there's a link between PMIs, which is sentiment surveys in particular, and trade policy uncertainty. Then I think you've had in the last few days and weeks the Russia-Ukraine conflict seemingly intensify. So that creates uncertainty. I think on top of that, because of Trump being elected and having this reflationary shift, global central bank cutting cycles have been repriced to be much more hawkish. And Europe needs lower rates. Manufacturing needs lower rates. So you have all these multiple factors currently weighing on Europe, and that has also made us being quite bearish across assets on Europe.
Christian, how much more how aggressively does the ECB need to cut rates? I mean, we had a conversation with Christine Lagarde a couple of weeks ago. Yesterday we spoke to the Greek central bank governor. I mean, traders now see a 50% chance of half a point ECB rate cut in December on the back of those disturbing PMIs.
I mean, they have a problem, of course. We have to be clear. It's not all that Trump has triggered that reflationary pricing in global central banks, but it's also the fact that inflation remains sticky a bit. Certainly in the UK, but also in the euro area, inflation has been a bit more sticky. And
services inflation,
absolutely right.
It just can't really get down like the others.
That's absolutely right, and I think it's to some extent less predictable because it's more domestic, it's more specific, it's not linked to oil, it's not linked to global factors or goods, which has been very disinflationary. So I think there is a bit of a challenge because we know the Fed cares about financial conditions, it cares about the equity market, it cares about growth, and they've already pivoted, they've shown they're responsive, they've shown they provide a central bank put. Whereas in Europe, we have obviously different mandates and a different history of being proactive versus reactive. So to some extent, the market is potentially waiting for a bit of a pivot, and that could help.
But Christian, so if there's the 10 to 20% tariffs that kind of could be base case for Donald Trump, and again, we have to see how the market reacts. We know that he looks at the market, but does it shave off 1 percentage point of GDP automatically of European countries? And again, how difficult is it in a time where Europe is not as competitive, frankly, as it should be?
Yeah, I mean, our European economists, they've done a lot of these exercises where they try to estimate the impact of tariffs, but you can imagine it's tough. Like, there's a lot of uncertainty. And the uncertainty creates also the issue of estimating it because it's path dependent. There's a lot of other things going on at the same time. There's a lot of sentiment components of growth that matter. So what we've estimated exactly as you said is that a 10% blanket tariff would shave off 100 basis points over a period of 2 years. And it could be a bit more front-loaded, but ultimately that's the case. Our team has shaved off maybe 50 to 60 basis points for now from euro area growth because the 10% blanket tariff is not our base case. But I think you can see already how the uncertainty, without anything having happened, weighs on activity. And that's what I mean. Like the uncertainty, like let's assume it's not a 10% blanket tariff, let's assume it's smaller, but there is an open-ended discussion that might actually keep uncertainty elevated and still weigh on growth.
But is it difficult to model? And again, does it hit different sectors differently? Yes, depends on the ones that are basically affected. But is it growth? Is it hitting growth before it actually increases inflation? I mean, could it be deflationary instead of inflationary? Is what I'm trying to say.
It's a really good question again. I mean, the uncertainty effect could really weigh on demand. If you have sharp price level effects, that could weigh on demand. But then you have to consider two things. First of all, inventories in the global goods sector are very low. No. So for 2 years, you've been destocking because you've already dealt with a slowdown. So you could also see a situation, if you start with the tariffs, that people are saying, wait a second, maybe I should restock. Because if you start with the tariffs, it could continue, and it actually could create a shorter dated, front-loaded pickup. And all these uncertainties make it incredibly difficult. And if you are an investor and if you're in the market, you just need to put more risk premium. And I think the market is doing that a bit right now.
All right, Christian, thanks so much. Christian Muller-Gleesman from Goldman Sachs stays with us. We'll talk a lot more about the U.S. economy, look at dollar, and also talk emerging markets. That's coming up next, and this is Bloomberg. From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Welcome back, everyone. Now, still with us, Christian Muller-Gleesman from Goldman Sachs. Christian, thanks so much for sticking around. We were talking a little bit before about what Europe needs to do to become a little bit more competitive, especially with the specter of tariffs and possible trade wars from Donald Trump. What does the Trump administration mean for the U.S. economy? So we're talking about deregulation, question marks about what role Bitcoin, frankly, has into this. He could go after Jay Powell or central bank independence. So does it change the dynamics within the U.S. economy?
Yeah, I think there's like four major blocks of policy that we've been focused on: deregulation, taxation, immigration, and the tariffs. And our macro baseline is a relatively friendly one. So our economists actually think that the policy mix that we're getting is roughly growth neutral. So GDP growth, we expect at 2.5% for next year, which is above consensus. Consensus at 1.9. So another year of the US outperforming and possibly beating expectations. So like the policy mix neutral for GDP growth, and it's slightly increasing inflation. So core PCE inflation type measures, because of the tariffs, we assume like a 20% tariff on China, and then tariffs on auto imports. If you have that, it will probably boost inflation by 30, 40 basis points. So that is not a terrible outcome in both relative to what we expected pre-Trump's election, but also relative to the rest of the world. So contained inflation pressures, still good growth. But there's a lot of question marks. There's a lot of question marks on timing of the implementation of the policies, how uncertainty hurt things, uncertainty related to tariffs, and I think to some extent also on the immigration, there's a lot of question marks if you create deregulation and taxation and generate some animal spirits in the domestic economy, and at the same time potentially reduce the labor supply, could inflation actually surprise to the upside?
But if you take out immigration, because that's been supporting the U.S. economy quite a lot, whether the legal or the illegal kind, I mean, does it change really the dynamics? Because we always thought, oh, this could be, you know, the force could be productivity, but if you look at the productivity numbers in the U.S., they haven't been great.
It depends. If you look at high-frequency productivity numbers, they've actually been quite good in the last few months, and our economists have been a bit surprised by that as well. So I think currently very high-frequency productivity numbers are well above 1%, and so to some extent that's obviously the hope. That the labor market can kind of rebalance partially via productivity, and if you have deregulation, taxation, investments, reshoring, there is a possibility, but it's a slow process normally. I think right now we know the U.S. labor market is somewhat tight. The unemployment rate close to 4%. Versus Nauru or versus history, it's low. So there's a certain late cycle element in the U.S. economy. So we know inflation is the biggest blind spot for investors. So we just have to be a bit vigilant next year.
Christian, what do you do with China? So again, these are, you know, Trump tariffs that were put in place like 5-6 years ago that the Biden administration kept. But the fall or in the China economy was self-made because of real estate. So it wasn't really hit that much by tariffs.
Yeah. I mean, I would say, as always, when we look at investments and economies, we want to understand three cycles: the structural cycle, the business cycle, and the sentiment cycle. So the structural cycle in China is very bad, and we don't even need to go over there. It's real estate, it's population growth, there's lots of geopolitical concerns. So let's put this to the side. We know that the business cycle has been very depressed in China. And this, as you are absolutely right, had not only to do with trade tariffs, it had to do with some of the structural issues becoming a bit more binding and weighing on the domestic economy, creating liquidity trap tendencies, and deflation, excess capacity. So I think these issues, to some extent, were trying to be addressed by policies like fiscal policy, monetary policy, going into the election already. And the sentiment was super bearish. Yeah. So putting this all together, you actually had China doing much better than most people expected this year. We had this big bounce, no? And now you're adding this new dimension of the US elections with potentially more tariff, more uncertainty, more challenging structural cycles. So you could say the ball is back in the court of the policymakers now. So they need to do more because there's more headwinds.
Christian, very, very quickly, does the dollar still rally from here?
I think we had this view that we know the dollar is a bit overvalued. We know that, to some extent, there's some convergence on monetary policy. So we were hoping the dollar would depreciate coming into this year. But our team has now shifted back to a dollar stronger for longer view. I think you just can't fight easily with the type of policy mix that you have in place and the strength of that economy.
So interesting. Christian, thank you so much for coming on today. Christian Müller-Guisman, Head of Asset Allocation Research at Goldman Sachs. Coming up, flirting with $100,000. We look at Bitcoin's rally towards six figures. That's next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Let's talk about Bitcoin. Bitcoin currently at, well, just very shy of 100,000 at 98,645. Now, the crypto market has gained around $1 trillion since the U.S. presidential election. So let's get more from Bloomberg's Emily Nicole. Emily, I mean, I look at this and I think, wow, we're like a whisker away from 100,000. I mean, this is a huge psychological level. Is this all Trump trade?
I mean, pretty much, yeah. If you look at the numbers in terms of how much has gone into the US ETFs since the election, that's $6.8 billion. If you think about how much the institutions have kind of been positioning for this after being very cautious over the summer, we can pretty much assume that a lot of this is coming from Trump optimism, especially with the resignation of Gary Gensler overnight as well at the SEC. All of this is kind of laying the groundwork for that inauguration day and what he plans to do on his first few days in office.
I mean, what happens at 100,000? I mean, do people pile, you know, even more in, or is it just a psychological level?
It depends a little bit about how people have got their trade set up. I was speaking to somebody last night from Wisdom Tree, actually, who was saying that there's a lot of that short squeeze stuff happening around $100,000, so we may actually see a big rip-roar past once we hit that figure. But there's also a bit of an understanding about how it affects the rest of the crypto market. Will we see it spill over onto the smaller cryptocurrencies? Will Ether have a bounce? There's a general sentiment that, you know, what's good for Bitcoin is good for the rest of crypto. But, you know, how it exactly plays out in terms of the way people trade, I mean, Bitcoin's the number one, so.
I know, so interesting. Emily, thank you so much for joining. We'll keep on following. I mean, it could hit it today, right?
Yeah.
I mean, we're so close to it.
The U.S. is yet to wake up, so anything can happen.
So today could be the day. Watch Bloomberg, listen to Bloomberg, read our stories as we bring you the very latest on Bitcoin. Emily Nicole there. Now, a little bit later today, also don't miss our interview with Richard Teng. He's the chief executive of Binance, so that will be, of course, a good conversation with the world's biggest crypto exchange on how he sees cryptos going forward. Coming up, Vladimir Putin says Russia launched a new kind of ballistic missile to attack Ukraine in retaliation for Kyiv's use of American and British-made missiles. We'll bring you more on the latest escalation. That's next, and this is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Donald Trump nominates longtime ally Pam Bondi to run the U.S. Justice Department after his first choice, Matt Gaetz, bows out of the running. The euro falls to its lowest level against the dollar since 2022 as euro area business activity unexpectedly slips into contraction. Plus, Israel rejects the International Criminal Court's arrest warrants for Benjamin Netanyahu over alleged war crimes in Gaza, calling the charges absurd and false. Now let's get on to some of the data that we had a little bit earlier on. Euro area business activity actually unexpectedly shrinking in November. This is a sign of the damage done being brought by political chaos, but also heightened discord over trade. So nothing's been announced from the U.S. side, but it's very clear that as people anticipated, there's a bit of a contraction, and euro area manufacturing falling to 45.6, actually 45.2 instead of 46, so worse than expected. And then the services were actually an expansion, or the forecast was for expansion. They fall into 49.2. So this is repricing how much we're expecting the ECB to cut rates, of course, in December. And I think 50% now of traders expect a 50 basis point cut by the ECB come December. All right, we're also getting some UK November services PMI. They're falling to 50. The forecast was 52. So that's kind of flatlining, or at least it's neither an expansionary or contractory. Of course, territory and then manufacturing falling to 48.6 instead of the 50 estimate. So actually, things are getting worse across the board. We'll have plenty more on that. We'll speak to Yakov in terms of the impact that some of these trade tariffs could have also on emerging markets. We'll get to that shortly. Now, Russia says it launched a new kind of ballistic missile to attack Ukraine, the latest escalation of hostilities, sending an alarming signal to Kyiv's Western backers. Now, let's bring in Bloomberg's Oliver Crook. Ollie, so what was fired and what fears does this raise?
Yeah, Francine, we had actually Vladimir Putin coming out yesterday and sort of addressing this very directly, saying that this was a new kind of missile that they had fired, that it was a direct retaliation from the Ukrainians using UK and US long-range missiles within Russian territory. There was a little bit of debate as to whether or not this was technically an intercontinental ballistic missile or a sort of more interim-range missile. The point is, though, Francine, this is a missile that traveled 1,000 kilometers from the Caspian Sea, you can see there, into Ukraine. It is the kind of missile that can carry a nuclear warhead, and it came the same week that Vladimir Putin really diminished the sort of level at which Russia would consider retaliating with nuclear force to attacks within its borders, coming at a time also when we got reporting that Vladimir Putin may be open to discussing sort of ceasefire negotiations, beginning those with Donald Trump. So it's very difficult to parse how much of this is sort of an organic escalation of this conflict, how much of it is sort of an escalation with a view to potentially negotiating a ceasefire in which everybody wants to be in the strongest possible position. And of course, the difference between those two is absolutely sort of fundamental. We did hear from the Kremlin, the spokesman Dmitry Peskov says that Russia holds responsible positions to prevent a nuclear conflict. We also understand from the Pentagon that the U.S. was alerted by the Russians that they were going to fire this missile through the sort of nuclear de-escalation channels. That being said, Francine, this is a conflict that has not really moved the markets for the last couple of months. You have seen that change this week. You look at just the gold, for example, this week, up more than 5%, the most it's moved since April.
Yeah, do we worry about these sanctions that Russia imposed on Gazprom and the impact this could have on gas also flowing into Europe?
Certainly, Francine, because the sort of strange sort of setup that we have in this war and we've had for the last couple of years is that there is still Russian gas flowing through Ukraine to Europe. That creates a dynamic where Europe is actually paying Russia, funding its war machine. Russia is paying Ukraine for the transit fees to transfer that gas into Europe, funding its war machine. And the way that that is happening, the way that the Europeans are able to pay the Russians is through Gazprom Bank. Now we understand the Biden administration has moved to sanction Gazprom Bank. It is the last bank, the sort of last large Russian bank that is accepting payments. So this could have an effect on some of the supplies that are flowing into Europe. That being said, this is a war that's been going on for 3 years. We know at the very center of it, fossil fuels from Russia have been right at the center of that discussion. It cannot be a shock to anybody that this could be coming. There was also the transit agreement of these gas flows was set to expire anyway at the end of this year, but we have seen sort of stockpiles falling a little bit. And Francine, longer term, when you think about what the potential impact is here, this could mean that Europe will buy potentially more natural gas from the United States. This is something that Donald Trump was talking about way before the war even began. He was lambasting the Germans regularly for buying too much gas from these from the Russians. So this is something that could be welcome news for the new president of the United States, Donald Trump.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, on Ukraine, Russia, and Germany. Now, the geopolitical uncertainty and a new U.S. administration with a stronger dollar on expectations of higher inflation is, of course, weighing on emerging markets. Our next guest says the mood music has soured, but under the surface, EM is far more insulated than the headlines may suggest. Well, Yakov Arnopolin is Emerging Market Portfolio Manager at PIMCO. Yakov, always good to speak to you, so thank you so much for coming in the studio. I mean, there's so much copy in saying when you look at the real losers of a Donald Trump victory, it could be the neighbors, Canada, Mexico, and, of course, depending on what happens with the dollar, a lot of the emerging markets.
Yeah, look, a lot going on, obviously, and the reality is we're still in something of a waiting mode. Jan 20th is 2 months away. The market is trying to kind of read the tea leaves, figure out, as we say, personnel as policy. To the extent we get some of the personnel appointments clear around Treasury and NEC in the coming days, maybe we'll have a little better sense of what's the direction of travel. But certainly trying to piece together what's the puzzle going to be in EM. And as you said, certainly we're careful around Asia. Unclear what the Chinese reaction function is going to be. It seems highly likely tariffs are coming. Looking at Mexico very closely. Yeah, but the reality is, if we take a step back, since the election, the Mexican peso is down a couple of percent versus the euro, which, as of this morning, is down 4+%, right? So, frankly, Europe may be at the epicenter of trade war, of tariffs, so where the battle between U.S. and China plays out. But again, for us, we're trying to figure out how we can produce alpha for our clients. And specifically, we look at places like Eastern Europe. So Czech Republic, local bonds look quite attractive. You can see a lot of risk premium. If they keep cutting rates to the extent Europe slows down, that could be a great trade as well.
And this is despite, I mean, if even if Donald Trump goes after NATO, pulls out of NATO, or actually says something on like trade and tariffs that could impact the Czech Republic, this would be still a good deal.
Look, I think we're looking at the correlation to Europe, correlation, let's say, to the European auto industry, where Czech Republic produces many auto parts that go to Germany and so on. So there are clear links to Europe. And then, again, equally, there are plenty of countries that, as we said, can actually be winners in this environment. Certainly Argentina, the Milei policies seem to really resonate with the Trump administration. He was the first to fly over to D.C. We've seen El Salvador bonds rallying, and Bukele seems quite close to Trump. And again, there is a hope maybe we won't get a resolution to all the conflicts in the world overnight, but to the extent the narrative changes in the Middle East, in Russia, Ukraine, hopefully we can actually price out some of that geopolitical risk premium that we've had in many of the bonds.
How difficult is it, Yakov, to look at the personal relationships, as you say, with Alex Milei and President Trump and say, actually, tariffs would go down? We've been trying to also figure out what happens with Modi and India, or do you focus on kind of just the immediate blanket policies?
Look, it's going to be, I think they'll be very specific in terms of going after potentially China, looking at Europe, looking at Mexico. So we've been thinking a lot about Mexico as well with a new Scheinbaum administration. What does that mean? And the sense is they're very aware that they will need to cut a deal. We have the USMCA, which is the old NAFTA, coming up for renegotiation in 2026. So 25 is going to be crunch time for Mexico to address its relationship with Trump. Again, I think it's a very technocratic cabinet that is going to look to cut a deal and figure out how to thread the needle there. So I think for now we are constructive in terms of inflation-linked bonds in Mexico, which is a safer asset. But there is a scenario where 2025 could be a decent year once the dust settles on the U.S.-Mexico relationship and how all of this plays out in terms of USMCA.
What do you do with Asian currencies?
Well, I think it's since I'd say careful for now, right? Careful for now until we see, as I was saying, the Chinese reaction function, see what happens after the administration, to the extent there is a weakening of the CNY fixing, how that impacts Asia. So I'd say for now, fairly cautious. And I'd say even the same goes towards India as well, allows them potentially to weaken the currency as well a little bit. So I'd say for now, if you look at our portfolio, we have very little beta to DXY, very little beta in terms of EM, right? So many of our trades, many of the overweights where we see value are far more idiosyncratic, right? Not beta, but idiosyncratic stories, places like the Turkish lira in the currency side, Egyptian pound, Nigerian naira, where they're far more insulated from DXY, from what the dollar is doing, and are, again, it's more in terms of what's going on, local policy, local rates, and how they pave the path.
Is there anything that you'd be selling off right now? I mean, again, it's January 20th. We have the inauguration, but in those 3 months, it also feels uncertain because a lot could happen because there's a power vacuum.
Well, look, the narrative in the market is that the euro is going towards parity with the dollar, right? And we're kind of seeing it play out this morning. So in fairness, we have had a lot of our FX longs and EM, some of these idiosyncratic stories, and the funding currency we've chosen in many cases has been the euro or the sterling. So that's worked nicely over the past several weeks.
Yakov, as always, thank you so much for coming on. That was Yakov Arnopolen, Emerging Markets Portfolio Manager at PIMCO. I would suggest emerging markets have never been so interesting. Coming up, the demand for AI is reshaping the labor market as companies prioritize employees with AI skills over those without. We're joined by LinkedIn's Vice President and Head of Global Public Policy next. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg. Welcome back, everyone. Now, since 2016, the presence of AI talent amongst LinkedIn members has tripled in Germany, Italy, and the UK. As AI reshapes industries, the skills needed for jobs, of course, are evolving at an accelerating rate. Well, Sue Duke, Vice President and Head of Global Public Policy at LinkedIn, joins us now. Sue, thank you for joining us. This is also at a time where there's a lot of question marks about the U.S. economy, about cryptocurrency. It feels like there's a lot more disruption than there was 3 years ago. AI and machine learning specialists are probably amongst the ones with the highest growth. Do you see that on LinkedIn?
We certainly see that change that you're talking about, Francine. We see that change happening out in the labour market. We see that change speeding up all the time. And we know from our members and from customers that they feel it too. Fully 2 out of every 3 workers are telling us, I feel like the workplace is changing at a pace like never before. And they're asking for help to get to grips of it. And as you say, 2 of the big changes that are shaping the labour market, one of those is AI and the other one is green. And as you say, when it comes to AI, we are seeing its impact throughout the economy. We are seeing companies demanding these roles. They're going out looking for workers, not only with those technical AI skills for those workers who are building AI, but also for workers who are leveraging AI to get more productivity, get to do more work and more valuable work in their more traditional jobs. And we're also seeing workers going out. They see this happening. They want to meet this change. And so they're going out, they're acquiring those skills. We've seen a triple-digit increase in workers going out and getting these AI aptitude skills just in the past year. And today, fully 3 in 4 workers are saying to us, I'm also bringing in my own AI to work because I can see the value it's driving, and I'm not necessarily getting the training and the support I need at work, so I'm taking control of it myself.
So there was a Gartner report estimating that about 85% of AI projects fail due to a lack of skilled professionals. Does that make it actually the most lucrative and competitive space for qualified people?
What that tells you is that if we get to grips with this technology, if we empower workers to leverage this technology so they can do more, so they can add more value, we are going to see the benefit of this right across the economy. And so what it tells us is we need companies to start investing in targeted training programs. Workers are telling us they want to use this technology, they want to get the training. And so what we know from that research and what we hear day in, day out from our own members is we need to start putting training in front of these workers so that they can optimize this technology, so they can start applying it in their day-to-day jobs and getting the results that we know are there if we approach this in the right way.
Sue, what can you tell us about green jobs? Again, there does seem to be a slowdown, if not even a retrenchment, also because of politics in the U.S. Does that change what people are searching for and the offerings on LinkedIn, or will that come in the future?
Green is one of those areas that's bucking that trend. You're absolutely right. We continue to see that economic uncertainty slowing down hiring in the broader economy, not when it comes to AI, as we said, and not when it comes to green. We really see those twin transitions of digital and green reshaping the economy, and green is such a great example of that. It has continued consistently to buck that trend of a slowdown in the broader economy over the past couple of years. We saw a 12% increase in the demand for those green skills just in the past 12 months. And we continue to see companies, again, right across the economy, not just in the green sector, in construction, in professional services, in tech, going out and looking for those workers. The challenge we have right now is we do not have the workers to meet that demand. And if we continue to go at the current rate by 2050, that all-important, crucial deadline year for meeting those net zero targets, by that year at the current rate, we will have twice as many jobs out there looking for workers with green skills as we will have workers with green skills. So again, we have got to start taking a targeted approach to training workers so that they're in a spot where they can take advantage of these twin transitions that are shaping the economy, that are going to deliver that growth, deliver those opportunities, and put the economy in the strong spot that we know it can get to.
Sue, so great to speak to you. Thank you so much for joining us. Sue Duke, they're Vice President and Head of Global Public Policy at LinkedIn. Now to some other stories making news today, and Elf Beauty has responded to a short report saying the company is fully confident in its financial statements. Now, short seller Carson Block of Muddy Waters Capital, who we interviewed yesterday, said he's shorting the company's shares and suspects it has overstated revenue in recent quarters. Now, he also claims a buildup in the beauty company's inventory was due to lackluster sales. Elf Beauty says the allegations are without merit. Shares in the firm have recovered after losing as much as 16% on Block's announcement. Now, Northvolt Chief Executive Peter Carlson is stepping down after the Swedish battery maker filed for bankruptcy protection in the U.S. yesterday. The firm's bid to secure rescue funding fell short, leaving it with just 1 week's cash on hand and debts totaling more than $5.8 billion. Now, Northvolt says it will continue operations as it seeks to restructure under Chapter 11. Now, coming up, the ICC issues an arrest warrant for Israeli Prime Minister Benjamin Netanyahu for alleged war crimes in the Gaza Strip. We'll bring you the latest. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Welcome back, everyone. Now, Israel has rejected what it describes as absurd and false charges against Benjamin Netanyahu in the International Criminal Court. The ICC has issued an arrest warrant for the Israeli Prime Minister over alleged war crimes in Gaza. Well, Bloomberg's Dan Williams joins us. Dan, why were warrants issued?
Well, for some months now, the special prosecutor of the ICC at The Hague has sought from the court arrest warrants against the Israeli Prime Minister, also the former Defense Minister Yoav Gallant, alleging war crimes, alleging crimes against humanity in the Gaza Strip, including accusations of deliberate starvation tactics against civilians there. This is something that obviously is vehemently denied by the Israelis and by their supporters, including the United States, which has called such charges baseless. But what this has done effectively for Israel, which is fighting a multi-front war going on 13 and a half months now, is open up a new front, a front of international jurisprudence with this world court, as it's often referred to, calling for the Netanyahu, a elected and serving prime minister, to face charges, and Netanyahu firing back by saying that this arrest warrant is misguided, malicious, and even anti-Semitic.
So how binding are these warrants?
very binding. There are 124 countries that are signatories to the Rome Statute that undergirds the court's authority. They are therefore required, when arrest warrants are issued, to enforce them should the person they're issued against set foot in their territory. This effectively will curb the travels of the Israeli Prime Minister, a man who, going on a quarter century now, has loomed large on the world stage and very much styles himself as a statesman. He's very well known for his speeches, for his telegenic English. With that said, there appear to be fissures already opening up in the West, including within Europe. The Hungarian Prime Minister saying just a few hours ago that he intends to invite Netanyahu to visit Budapest as a sign of defiance that Hungary will not enforce this arrest warrant. Meanwhile, in the United States, as I noted, the outgoing Biden administration has been very supportive of Israel. Potentially, the incoming Trump administration will be even more supportive. A number of Republican lawmakers already saying that they would intend to pursue legislation in the United States that was penalize any country enforcing such arrest warrants against the Israeli leadership, potentially imposing sanctions on the court itself. So this story has only just begun, and we'll see in the coming days and weeks what unfolds. This could actually mark, it would appear, potentially the unraveling of the authority of this court.
So, Dan, does Israel have the ability to overturn this, and does it effectively mean that the Prime Minister can't travel?
Effectively, yes. He will have to rethink every travel plan, every plan will take into a country that's a signatory at the ICC, unless presumably he receives explicit assurances from that country that the government does not intend to enforce the arrest warrant. Of course, the United States is not a signatory, can continue traveling there. As for Israeli recourse, Israel is not a signatory either. It did actually try to lodge a contest during the procedure. It's worth noting that this process was in the works at least since May, when the prosecutor submitted or announced that he was submitting his request for those arrest warrants. In that time period, the Israelis pursued counteraction within the court system. They tried to persuade it to abandon or to turn down this request. And the court, in announcing yesterday that it was issuing the arrest warrants, also noted that it was throwing out the Israeli contest submitted against the arrest warrant. So it suggests that Israel's recourse is pretty much exhausted at this point. What it will be looking at is American actions, and on a bilateral basis, the actions of countries, for example, Hungary, most recently, that it might look to not to abide by these arrest warrants.
Dan, thank you so much, Dan Williams. Up next, to Bloomberg Brief, and this is Bloomberg.
Casualty insurance. It's a tough game. There are temptations to be stupid in it. It's like banking. Once I asked the man who just left a large investment bank, and I said, "How does your firm make its money?" He said, "Off the top, off the bottom, off both sides, and in the middle." The general system for money management requires people to pretend that they can do something that they can't do, and to pretend to like it when they really don't. And I think that's a terrible way to spend your life, but it's very well paid.
I'll raise. I fold. Where's Warren? Well, unfortunately, I wasn't Warren's type. Oh, well, who needs a billionaire anyway, right? Oh, I got myself a billionaire. It's just not Warren. Come in, sweetie.
really Jamie Lee Curtis?
Is this really Mr. Hunger? I mean, Munger, excuse me. Please call me Jamie as long as I can call you Charlie.
Hi, Charlie. I'm Susan Lucci. Oh, haven't you heard about the deal between Warren and me? He's going to be a big star and all my children, and I'm going to be taking over Berkshire Hathaway.
Well, you certainly got some important qualities that Warren lacks.
Well, thank you, Charlie. There's some changes I really think we need to make around here. The first thing we need to look at is our dividend policy. I have never heard of anything so cheap and so unfair to our wonderful shareholders. We need to change it.
Sounds good to me. Charlie, have you seen the new trailer for Iron Man 3? It's really amazing. Iron who? Charlie will get on his knees for you. I can check, please. Yeah. Do we have a deal?
Okay, yes.
Oh, thank you. Charlie, it's about time. I'm right up.
Who's that, Charlie? Oh, give me the phone. Give me the phone. Give me the phone. Charlie, it's Jamie. Oh, it's so fun talking to you, too.
1, 2, 3. Hi, Warren Buffett. All right. I'm going to call my partner and have him draw up the papers. Wait a minute. Did you just put that piece of brittle back in the batch? Try that. Contaminated the whole thing. Charlie? It's done. Slick, yo. Brittle, bitches.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
America's at HSBC. Nicole, I mean, this is unashamedly bullish calls from across the street. Are you unashamedly bullish for 2025? Good morning.
Good morning. Good morning. How are you? Oh, well, when you look at 2025, you're looking at earnings growth. Right now, consensus has about 15% earnings growth for next year. And when we look at kind of quarterly results recently from the companies, corporate guidance continues to be very positive. So when we look at the U.S., we look at guidance sentiment across sectors, and it's improved in almost every single sector. So I think that bodes well for this earnings growth story for 2025. I will say valuations, I think a re-rating story is starting to get a little bit more difficult. You have stocks trading at very lofty valuations. So I think it's less of a re-rating story and more of an earnings growth story for 2025.
Look, I started the show by saying for Bank of America, the Flow Show comes out at 5 a.m. every Friday, and the secret sauce for Hartnett is a drop in yields. How much of the momentum for next year is predicated on that?
Well, you know, we are estimating the 10-year to get to 3.5, and obviously that's extremely supportive for equities, and that is supportive for the valuation story. I still think it's more a earnings growth story. I don't think yields need to come down that far for us to get good equity returns. And I think part of that is what we've seen so far is that even with high rates, the U.S. consumer has continued to do well. We still see that resilience. So I don't think it's necessarily the yields have to come down. I think it's more we need to see this earnings growth story play out.
Well, one thing that is powering ahead, I know it's always interesting when you get the head of equities talking to you about the dollar, and even more so when it's the head of U.S. equities telling me about the strength of the dollar, because I always thought for you equity teams it was like a sort of an immaterial aside, but it's not for you. You flag it very clearly, and stark reality. 8 weeks in a row we have this powering ahead of the dollar. The euro's touching the lowest since 2022 this morning on the back of slack PMIs. Talk to me about the headwind or not from a strong dollar.
Sure. So we're getting this question a lot from investors because the dollar has strengthened so much. We do expect to continue strengthening in the dollar. The U.S. equity market, it's really a domestically focused market. So 70% of the revenue is coming from domestic sources. So it's not a headwind or tailwind in that sense. You don't have that currency mismatch that you do have in different sort of equity markets. But what we find is during periods of dollar strength, the U.S. market tends to outperform other equity markets. And a lot of this is because of the reason why is the dollar strengthening. The dollar strengthening because you're seeing relatively higher U.S. growth compared to the rest of the world. You're seeing higher U.S. yields. So these are the reasons why the U.S. dollar strengthening, and that kind of plays into the fact that the U.S. equity market during periods of dollar strength should outperform other equity markets around the world. But, you do definitely see various differences among sectors in terms of exposures to the U.S. dollar compared to others.
If your base case is earnings will outperform, I'm not overly worried about a decline in rates. But then the other side of this trade going into 2025 is that how much of this asset, I suppose, supremacy for the United States equity story is predicated on getting those tax cuts down to 15% on the corporate tax level, and at the same time not having onerous or penal tariffs that perhaps can bruise the growth story.
Yeah, no, it's a good question. I think when we think about that, when we think about policy change, the potential for policy change for next year, we don't know the extent, we don't know the sequencing of it, and we're really looking at in terms of a sector basis how to play this, looking at what sectors could outperform and what sectors we think could underperform on a relative basis. And what we're saying, we like financials, we like tech, we like industrials on a kind of pro-cyclical story for next year. And I think on the other end of the spectrum, the consumer staples, consumer discretionary, I think these are the sectors that if we get these tariffs that come through, a lot of these companies, they import a big share of their products. They're either going to have to pass that on to the consumer or take this on in the margin. And we know these companies do have very, very tight margins. So I think looking at the potential for policy change next year, what we're really talking about is how to play that in terms of the different sectors in the S&P.
Look, there were three things for me that cleared the decks this week. One was NVIDIA. Finally, we moved on. And it recovered. It recovered from being down 5% at one juncture in the after hours. The other two things that I discovered were we're leaving Target and we're going to Walmart. And once you go in through the doors there, you don't leave. Now, I know you can't talk about individual names per se, but this shows to me that there is a real risk that unemployment, if it rises from 4.1%, can materially impact the quartile that are shopping at Target and Walmart. And that's the critically important part of the narrative, isn't it, for next year?
Yeah, well, this is really playing into this K-shaped consumer that we've been talking about a lot this whole year. And we see this playing out through the companies, through the earnings, where you're seeing some consumer companies doing extremely well because they're focused on a high-income consumer, or they're able to invest in price and bring in the consumer to their stores and gain market share. So it becomes a market share gain story for these companies that are focused on kind of a mid-lower end consumer. So that's why in these sectors, we've always said you need to be very selective. And then going into next year, if rates stay higher for longer, I think that K-shaped typed consumer continues to persist over 2025, and you need to continue to be selective in those sectors.
Good to get the K back in the lexicon again. It's been a while since I've had that on the show. Nicole, thank you so much. Nicole Inouye there from HSBC. Other stories trending on your Bloomberg terminal this morning. This is what we got for you. DirecTV has called off the takeover with Dish after they failed to win the consent of the bondholders for a key debt exchange. Dish hasn't initiated fresh discussions, and the merger would have created the largest US pay TV provider, with DirecTV assuming $9.75 billion of debt. The Swedish EV supplier Northvolt filed for bankruptcy in the US after a desperate bid to secure rescue funding that fell short. Now, it was about $30 million in available cash and $5.8 billion in debt. According to the filing, the CEO is stepping down from his role. Euro area business activity shrank in November, with the PMI falling to 48.1 from 50, with traders ramping up their ECB easing bets. Analysts also estimated no change and were particularly surprised by the steep deterioration in the services, with the activity dropping for the first time since January. Coming up, Matt Gaetz pulls out. Pam Bondi is the President-elect's new Attorney General pick. We'll dive into the cabinet choices. And what does a red wave in Washington mean for credit? We'll discuss with Megan Robson of BNP Paribas a little bit later this hour.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell.
Earnings from Caesars crossing the Bloomberg terminal. Mondelez is reporting
Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate. When your comps get tougher, how much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
I respect his decision, appreciate him offering himself for service at that level, now on to somebody else.
I'm sure it's the right decision. If he feels like it is, and the president feels like it is, the president deserves to have a cabinet who is going to implement his agenda and serve his interests. And so I saw the president's statement. And, I trust his judgment.
His confirmation process will move more quickly and be more successful if he nominates more confirmable candidates.
There's a sense of relief about it, of course. I think he did a pretty noble thing, frankly,
honorable thing by getting out himself. I thought his statement was appropriate, and I look forward to a new nominee that we can get fully behind.
Reactions from the Republican senators there to the news that the former Florida Congressman Matt Gaetz has pulled out of consideration for joining President Donald Trump's next cabinet as Attorney General. Now, Trump has instead handed the role to a former Florida Attorney General, Pam Bondi, pending confirmation, of course. Derek Waldbank is with me. Derek, it's interesting, a more confirmable name. This lady is eminently a different caliber of person. Perhaps she has worked closely with Trump, but the line that I was drawn to was, this is a warning shot from the Senate in terms of the scale of the rebellion from the hell knows.
I think, look, the only reason why someone like Matt Gaetz pulls out in this case is because he didn't have the votes, and he didn't have the votes at this point. You know, there were a lot of reports on where the vote count sort of was, and it's very, very early days, but it was very clear that there was a lot of widespread opposition and even more questioning, and that Donald Trump was going to have to use an awful lot of political capital to try and get this even close to the margin for getting over. In having Gaetz depart and having Pam Bondi come in, she's a former attorney general in the state of Florida, Trump instead gets to have most of the things that Gaetz might do anyway, a lot of the policies that he might look to do, a lot of that stuff goes through. She's not too different in terms of what she would maybe want to do as Attorney General, but far more confirmable. I think right now that's the general view that we're seeing. This nomination is landing very, very differently than the Gaetz nomination did. As to say, you know, she spent 8 years as Florida's Attorney General. She was a practicing attorney before that. So she has a certain level of different experience there. The other thing I think is pretty interesting about her is that she did at one point have a chance to make a decision about what to do about Trump University. When that was under some scrutiny, she declined to take action there. She was also a member of Trump's impeachment defense team, so she's somebody that has been close to the president elect in moments of his own political difficulty and stuck by him at that point.
It's going to be interesting to see where she maybe stands on the enemy from within. She's chair of the America First Policy Institute. In terms of the Treasury choice, look, this vacuum is still open. We were reporting earlier in the week that there could be some kind of a chess piece move with Wash as Treasury Secretary and then going to the Fed. The Journal obviously running with this a little bit more hotter and heavier this morning. Again, these chess moves, how do you think the market would take that kind of a calibration?
Well, yeah, man, I think that the more delay that we've got going on, the more speculation we're going to invite here, right? And so former Fed Governor Kevin Warsh is one of those three names that we keep hearing. Scott Bessent is another. Mark Rowan is another. Those are sort of the three names that I think you read if you see the second paragraph of the Bloomberg story out right now, or a lot of other reports that you might read somewhere else. They all sort of come around those three names, right? But it's a question of where you go and how you place them. And so there's a possibility that Trump will pick one for one job and another person from another job. It's hard to say right now. And Trump, for not having picked this already, this is one of the highest profile jobs. It's a position that does everything from signing the money all the way to enforcing trade sanctions and sort of setting that policy. So you would imagine in a Trump administration, this is going to be pretty big. He is tending to consider heavyweight names for this. People who are very, very well known in street circles are being considered for this. So it's not like Wall Street is going to be considering fly-by-night names here. But yeah, you can see a certain amount of what about this? What about this else? You know, if this person doesn't get this, where else might they land? That sort of parlor game is going to go on until Trump announces this, and that announcement could come at any moment, really, whenever he decides to make that decision, because he is the person who's going to be making this decision at the end of the day. him by himself.
Yeah, it's certainly going to have an impact as well in terms of where we go with tariffs. And the question is, of course, are you loyal to my tariff policy, or have you got fealty to my tariff policy? And they are two very, very different things for bond markets. Derek, thank you very much. Derek Wallbank there on the very latest Trump picks. Coming up, Google falling pre-market, a possible new search engine stepping in. What are the details? We'll run you through them next on Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making. That's what we cover each week on our podcast, The Deal. I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never.
Go.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Here's Bloomberg Brief. I'm Manish Crenny in New York. Front pages, this is what we got for you from around the world. First up, we will kick it off with the New York Times. Senator Bob Casey has conceded to his Republican opponent, David McCormick. The race was so close it triggered a recount with a margin less than 0.5%. McCormick, a former hedge fund CEO, he won with the help of the enthusiasm for the President-elect Trump and billionaire contributions. Next up, Financial Times leads with the SEC chair, Gary Gensler, has announced he will step down January 20th. Gensler's departure will leave the SEC in the hands of the acting chair. Trump's upcoming pick will likely unwind Gensler's signature rules and have a more crypto-friendly approach. And on the information, shares of Alphabet are falling pre-market. It's reported that OpenAI is considering developing a web browser. It's just another strike for Alphabet after the DOJ proposed major changes to Google, including a forced sale of its Chrome browser. How likely is that? Let's talk about the Alphabet story. Tamlin Basson is with us from Bloomberg Intelligence. Tamlin, obviously, there's the remedies that are available to the judge. They are wide, and they can be very aggressive, from spinning off Chrome to perhaps addressing some of the exclusive payments. Where do you think we will fall over the next year?
Yeah, and I think that's really what the market was trying to digest yesterday when we actually saw sort of the scope of the remedies that are being put forward by the DOJ. And this is a remedy that's going to be decided, or there's going to be a trial in April where the judge is going to consider all this. Now, in terms of the worst case scenario, that would be the divestment of Chrome, we think that's a bit unlikely. Just if you go back and you look at the finding that the judge made on liability, it was a fairly well-reasoned finding. We think the judge is more likely going to try to find sort of the narrowest remedy that really addresses this illegal monopoly. So that might put in scope sort of these exclusive payments to be the default search engine on things like iOS. We think that's certainly something that is definitely something that's going to be considered by the judge at this April hearing. Then we're going to have a final outcome likely in August of next year.
It's going to be quite a slog, isn't it? And if they do have to hive off Chrome, of course, that puts them way, way back in the line in terms of the AI, their AI product on Gemini. And of course, then to add sort of insult to injury, you've got OpenAI. The story is talking about developing their own search product. Now, this is not something which will happen immediately, but talk me through the proposition.
Yeah, and I think so the potential ramifications of generative AI on the search business is something that's been fairly widespread. And I think part of this is why Google has spent so much money on Gemini, trying to sort of entrench itself and strengthen that moat it has on search. So sort of the news reports that OpenAI is now sort of kicking the tires on building some search products, maybe coupling, getting on devices. You know, I think this is certainly a potential threat to Google going forward. And it's something that I think the market's going to have to pay close attention to. On the other hand, I think you're right. This isn't going to happen overnight. It took a long time for Google to build this sort of dominant position in search. So it's not going to be an overnight thing, but it is something that the market is going to be looking at very closely going forward.
Okay, well, it's one of those great stories, isn't it? I mean, there's a long distance between the investigation, the preparation, and the delivery. Other people have tried in that space. Remember Bing? Tamlin Basson there of Bloomberg Intelligence. I want to leave you with a snapshot of what's going on in the foreign exchange market. We've had the PMIs out of Europe, and they were pretty dismal. You're looking at the euro dollar, the lowest since 2022. The PMIs dropped into contraction, 48.1 from 50 in October. So unexpectedly in a contraction there, and the betting markets have fired up to 50 basis point cut in December from the ECB. Sterling also under pressure as well, but it is down to the alpha of the dollar. 8 weeks in a row it has been rising, to the extent that you got equity investors asking the head of HSBC Equities, what is the risk from such a robust dollar? That is what you call a strength and a showing. Coming up, Megan Robson of BNP Paribas joins me to talk about these tighter credit spreads right here on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zay Poland he did come to me and Susan O'Malley, and they said, Abe Polson says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Menace Cranny. Let's set your agenda. The rumor mill endures on the top Treasury pick as Gates bails. President-elect Trump taps the former Florida Attorney General to run the Justice Department. Sustaining the Trump trades, Bitcoin delivers another record high, flirting with $100,000, and the dollar on track for an 8th weekly gain. And all that ahead of the latest U.S. consumer sentiment and PMI data, while activities come in weaker than expected across Europe. Good morning. Equity markets, they are just starting slightly on the back foot this morning, and even the Russell has dipped. The Russell put on 1.7% yesterday. Still 7 weeks of flows of money into the U.S. equity market, $16 billion according to Bank of America. And we're looking at a record inflow this year of $448 billion. Double-digit return will come next year, according to Hartnett at Bank of America. But the secret sauce for that is going to be lower yields. Let me just roll it over, have a look at those yields. Again, the outflows from bonds over the past 2 weeks, we've seen a considerable outflow. Yields drop 3 basis points on the 10s this morning. Money has been flowing out. $6.4 billion has flowed out over the past 2 weeks. But PIMCO say these kind of levels, you want to set yourself up here. These are attractive levels to pick up yield, and you will get a little bit of carry next year. The Fed cuts will come, and you will get an appreciation. So let me just leave you with a snapshot of Bitcoin the past 5 days. Gary Gensler, we know, is stepping down. The flow into the ETFs has been really quite phenomenal. You're looking at $773 million of record inflows into the ETFs over the past period of time. So that momentum is there. Can we make it to $100 before we leave the office for the day? Well, BNP's Megan Robson weighs in on the implications of the Republican sweep, writing this. A red wave outcome should support tighter credit spreads, compression, flatter credit curves. In our view, the tail risk remains a bear steepening of the yield curve and potential tariffs. That's all for 2025. Megan is, of course, the head of U.S. credit strategy at BNP Paribas. Good morning. Good to see you.
Good morning. Thanks for having me.
So do you share this sort of sense of euphoria in these markets? I'm looking at the tightest spreads for IG since 1998 and the tightest for high yield since 2007. That's euphoric.
It is. You know, the reaction has been extremely positive. I think not only just getting past that uncertainty of the U.S. election, getting an outcome regardless of who it is, but also the fact that we got the red sweep. And I think that has really pushed us to tighter levels. For investment grade, we're sitting right at our year-end spread target, so not much room for tightening there. In high yield, we're about 20 basis points off of the level we expect into year-end, so about a little bit room for compression there, outperformance of high yield into the end of the year.
Okay, so that takes us to the end of the year. But then I suppose the debate becomes, what is the dislocator or what is the tail risk for 2025? What is the most significant tail risk to disrupt the compression?
So I think that the clear tail risk is going to be a reacceleration in inflation. And you've already started to see early signs of that coming into the picture with Powell saying we're going to hike or we're going to cut at a slower pace.
Yeah.
December, initially we thought for sure would be a 25 basis point rate cut, and now it's back in play. So depending on the policies, if he really moves forward with a lot of deficit spending next year and is able to get that passed, or else if he employs tariffs, I think both of those could be inflationary. And for credit, the real bear case is that we don't see rate cuts and potentially see rate hikes, and that's the tail outcome.
I mean, various people have been in that seat this week. Marco Papic from BCA said Trump is a human steepener, whatever way you look at this. Would you go so far as to say that until you know the actual policy of tax and the scale of actual tariffs?
I think it's very difficult to make a call with conviction on where things will go without knowing where policy proceeds. But I do think it's a bear steepening bias. And for credit, we think that supports outperformance of the long end. So look at long end investment grade. A bear steepener means not only higher yields for investors to invest in, it also means that issuers, instead of issuing 10+ long-dated bonds, they will tend to issue earlier on the curve, and so that supports long-end IG. I think that's a high-conviction view of ours under the Trump regime.
Can we just drill in a little bit on the fiscal policy? The promise is 21% to 15%. We don't know what the qualification is on that. I look back to 2016. Of course, it was 35 to 21%. But you've run the numbers in terms of if we do get a recalibration of tax from 21 to 15. How does that play out?
So I think it would be a boost, 6 to 7% boost to earnings if we do get those tax cuts. I think given the margins in Congress, though, I think it's becoming less likely that we'll really get that drop from 21 to 15. So maybe 21 to 20, maybe a slight decline.
Very
but really
incremental, isn't it?
it's very incremental on the corporate tax side. There are other provisions, though, that could be positive. So Republicans have talked about changes to interest deductibility. So for high yield corporates, that could mean they can deduct more of their interest from their tax bill. That would be a huge boost to some of our lower quality high yield companies. But headline tax rate, we're not expecting much change there.
When you talk about the change across the curve on where some of the issuance may come, it's going to be at the shorter end of the curve. The scale of issuance going into 2025, we started this year talking about a wall of refunding, and there was going to be this sort of crunch point, which never really actualized. There was a lot of refunding done earlier in the year. 2025, what scale of issuance do you expect?
So for investment grade, we're expecting a pickup to 1.7 trillion. So for context, we'll probably end this year at 1.5 trillion. A lot of that is going to be redemptions or refi of. We had a lot of issuance during COVID with maturity coming due next year. So for IG, that will be a big story. But also, I do think there's going to be a pickup in M&A. We have that sort of percolation of animal spirits. You're seeing some early signs that we could be seeing that. The Empire State Manufacturing saw a spike. Philly Fed less so. But should we see issuers really focus in on this being a better operating environment, less regulation? I think the M&A issuance is really going to move the needle in IG, but also in high yield.
Okay, Megan, we'll keep an eye on that. As you said, deregulation and a whole spring clean on that front can help the market. Megan Robson there of BNP. Coming up on the show, geopolitical risks and a new White House. We'll unpack how it affects the energy markets with Rapid Energy founder Bob McNally. That's next on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
In case you missed it, on Bloomberg Technology.
We are very focused on playing one game and one game only, and that is being free, frictionless entertainment for consumers. But what I will say is we are doubling down on the strategy. We believe it's working. We think the tailwind's in our favor, and it's on us to continue to deliver.
Whenever you're doing something innovative that hasn't been done before, there's a lot of trial and error and iteration. It just always has these zigs and zags along the way, and I think where we've been successful is really being reactive.
Hollywood is the history of technology. Like, we are here because of technological breakthrough, right? And so we sometimes forget that art and technology kind of like come together always. And for us, it's like demystifying a little bit the technology. Again, if you understand AI as a tool for humans, then it changes the narrative. And it's less about fearing it and more about embracing it.
Don't miss Bloomberg Technology, live every weekday.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States. Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
It is your Bloomberg Brief. I'm Manish Kani here in New York. Oil's headed for its biggest weekly gain since early October. The tensions escalate between Russia and Ukraine. This comes as we prepare for a new Trump administration with the Energy Secretary nominee, Chris Wright, and Doug Burgum as the head of the newly created National Energy Council. My guest this morning is Rapid Energy founder Bob McNally. Bob, you know a thing or two about the administration. You were with George W. Bush between 2001 and 2003. We'll draw on that expertise in just a moment. Talk to me about the price action this week. There was more of a bid to oil on the back of Russia's escalation relative to Ukraine. Where are we in the escalation of risk analysis of war?
Good morning, Manis. Yes, you know, since the summer, crude's been pinned between 70 on the bottom, 80 on the top, more recently 75 on the top. It's geopolitical risk on the upside, macro concerns on the downside. You know, right now, I think we are still complacent about geopolitical disruption risk. Look, before the election, the president and after, the market was rightly focused on the bearish and macro risk, tariffs, trade war, debt, interest rates, and we agree with that. However, my sense is until the election, they overlooked the geopolitical disruption risks coming from sanctions, mainly Iran, maximum pressure 2.0, but also, as we're seeing from Russia, President Biden on his way out is starting to wind up a little more on sanctioning Russian gas, although we don't think the U.S. sanctions this week will be too impactful. They can find workarounds. However, President Trump, we think, will be willing, if necessary, as with Iran, to crimp Russian energy exports to get leverage for deals he wants to cut.
So you expect maximum Iran pressure, but 1.5 million barrels a day, is that going to move the needle for OPEC Plus?
Oh, certainly if it materializes. But, you know, OPEC Plus is not going to make policy based on that possibility, right? They saw that in 2018. Saudi Arabia preemptively hiked ahead of sanctions on Iran that were supposed to be coming. President Trump delayed the sanctions. Prices collapsed. They're not going to play that game again. You know, we only see about 500,000 barrels a day going down from Iran. I think China will be incremental in reducing its supplies from Iran to placate President Trump. But it's possible it goes bigger. But Manis, if President Trump really goes whole hog and they take down 1 million or 1.2 million of Iranian oil exports, that would remove oversupply next year. That makes it much easier for OPEC Plus to return those barrels.
So this is a game of chess, really, in terms of what maximum pressure looks like from this next Trump administration.
You know, that's right. But the incoming advisors from Marco Rubio on down, the White House National Security Advisor, they are all Iran hawks. Right up there with Russia, the priority is to leverage Iran's vulnerability to oil sanctions exports. Their economy is much worse off now than it was in the first term, and get to a deal. So I think you're going to see that pretty soon. And I think until recently, the market was pretty complacent about it.
If we move then to a scenario of where there is some kind of an end to the Russia-Ukraine conflict, as Trump has promised, what are the implications there? Because they're not just going to suddenly turn on, access or accepting Russian oil, are we?
You're right, Manus. No, we're thinking this will end like the Korean War ended, or Cyprus, or Kashmir. They will cease firing along current lines. There will be an armistice, but no peace treaty, no easing of sanctions, and so forth. We think we're far away from any kind of a genuine peace treaty in which you would see sanctions come down. If anything, sanctions are probably heading tighter, not looser.
Just how much tighter could that get on the energy front, Bob?
How much higher could things go? Well, look, Iran is the big wild card. We're coming to a crossroads in Iran. If with Iran and Israel, either we're going to have a comprehensive deal with President Trump, will resolve the nuclear concerns, the regional concerns, terrorism, support for Russia on the one hand, or we fear next year is going to be a pivot point. We think Iran is so close to its nuclear program. Israel is able and willing to attack that nuclear program if it is attacked again. So, Manus, we think next year is going to be a year of decision where it's going to get a lot more bearish, if you will, or a lot more bullish.
Okay, we're in the pivot points. I want to squeeze a couple of things in here, Bob. In the phrase on the campaign trail was energy dominance. What does that really mean?
You know, I think for the Trump folks, that means maintaining our position as one of the world's largest, now the world's largest hydrocarbon producer and exporter, not fooling around with export restrictions like the Democrats have been doing. So maintaining that healthy, vibrant U.S. oil and gas sector and removing threats to it from climate regulations or anything else. The challenge for them, Manus, is that, you can have a $30 or $40 crude oil price if you want to get rid of inflation. The president can't drive it there, but that can happen. Mm-hmm. Or you can have a thriving shale sector, but shale can't live at $30 or $40 crude. So there is a tension a bit, I think, between the idea that we need to drive energy prices lower. Again, the president can't do that. Only Saudi Arabia could do that by opening the taps near term. If that happened, it would hurt shale. We saw that movie. You and I saw it in 2020. Yep. And we would see it again.
But what capacity does America have to really ramp up? How much spare production capacity is there in U.S. oil?
0.0 million barrels a day. We haven't had spare production capacity since early 19...
So then how do you get dominance? Is that deregulation just letting you square it for me? Because it doesn't make sense. If you've got 000 capacity and you want dominance, put the two together, because I can't do the math.
The only way you can do it is to dial 1-800-RIAD. The only option that any president has to quickly reduce oil supply, increase oil supply to reduce prices, is to call OPEC Plus leadership and successfully convince them to open the taps. I don't think that's going to happen here, but that's the only, believe me, I looked for the magic wand 20 years ago. That's the only option any president has to increase supply. The U.S. doesn't have spare capacity.
But you were on the National Energy Council 20 years ago and the National Security Council 20 years ago. You were busy. Give me your take in 60 seconds on Doug Burgum, the energy czar, and Chris Wright, secretary, the nominee for energy.
I think they're fantastic. I think they're going to be full-throated defenders of all of the above energy approach. You look at especially Chris Wright. He's okay with geothermal, batteries, nuclear reactors. It's not all about oil and gas for him. But you know what, Manus? It's not just the U.S. Around the world, look at Europe. Look where Europe is going. Look at this German election that's coming up. Look at the elections we've seen this year in Europe. The world is moving back to not anti-clean energy, but more of a all-of-the-above reasonable regulations approach. And with Governor Burgum and Chris Wright, I think you're going to see that and hear that in spades. So I think it's they're great choices.
Bob, great to have you with me this morning. Thank you for getting up early. That is Bob McNally of Rapid Energy, the founder. Let's get a little bit more on the next administration, what it looks like from energy to the rest of the picks. President-elect Trump appointed the former Florida Attorney General Pam Bondi as Attorney General. And that, of course, is pending confirmation. And that's after the former Florida Congressman Matt Gaetz, withdrew from consideration. Stephanie Lai is Bloomberg White House reporter. Stephanie, good morning. To what extent was this a message from the Senate that we will not be bullied around?
I think it is a little too soon to say if this is the moment of show that they're not going to that they're going to continue to stand their ground on issues that that matter most to them. On the Gates issue, it was very clear that he didn't have the support, and sources were telling my colleagues and I that it became very abundantly clear on Thursday based on new information coming forward to the Ethics Committee. And so this is a very unique case, and I think in Trump selecting Pam Bondi, someone who is both qualified and easily confirmable, it does show that they are willing to take a step back and reevaluate. But of course, that was after being forced to reconsider the AG nomination. But I think that is something that a lot of us in Washington and on the Hill are watching very closely, just how much leeway these senators are going to give the president on certain matters. But when it comes to some of his major legislative policies, it does not seem like he will have the same sort of pushback.
Well, it saves them from having to vote no in the very first instance, and maybe that's the graceful exit for both. We're talking about Pam Bondi here as the replacement. How do you think she's going to approach the various ministries that are going to be in her portfolio? Is she going to back the enemy from within clearance that President-elect Trump has often said that he wants to achieve?
Well, even when Gates was the selection, it wasn't entirely clear if he would follow that mandate so strictly. I don't necessarily know if Pam Bondi would either, but she is seen and highly respected among people in Trump's orbit. As one of his lawyers in the past, people do have a lot of respect in the work that she's done. So you can expect that same sort of deference to the president. And in fact, part of her appointment could have been due to the loyalty that she's shown in the past.
And we're still, of course, waiting to hear who is the Treasury appointment. The Journal runs with what we've been talking about pretty much all week, which is Walsh would go to Treasury for a couple of years and then go to the Fed. So this would be a very elegant sequencing, and it would perhaps keep Bessent in play at NEC.
Certainly. I do believe, though, that there is, as we haven't seen a decision yet, it's very likely that the president is still considering this option. If it was something that was a done deal, we probably would have heard it sooner, just in the fact that these appointments have been coming so quickly. And so that is definitely something that we've been hearing, though the outcome of it might not necessarily be as that plan dictates.
Okay. Well, we wait to see. Let's see if we can wrap it up before the close of business this week. Stephanie Lai, they're joining us from Palm Beach. I want to give you a quick snapshot of what's going on the currencies. You've got 8 weeks of gains on this dollar. There's just like nothing stopping it. But look at the euro, down nearly 0.5%. That's the lowest since, well, that's a 2-year low, November of 2022. You've got the PMIs crumbling back into contraction, 48.1 from 50 in October. And then you've got the rates market doubling down on 50 basis point cut from the ECB in December. So this is a widening, as it were, of the tension between the euro and the dollar. And sterling also off 0.5% as well this morning. So you're just seeing the triumph of the dollar there. Coming up on the show, we'll set you up for your trading day, a little bit of economic data and some Fed speak for you. Context matters every day on Bloomberg from New York. Good morning.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more. It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
I am gravely concerned that the rise of tariffs puts us on a slippery slope towards cronyism capital. For the American companies that produce goods in America, there's unquestionably a short-term benefit. Those same companies that enjoy that momentary sugar rush of having their competitors removed from the battlefield soon become complacent, soon take for granted their newfound economic superiority, and frankly, they become less competitive on both the world stage and less competitive at meeting the needs of the American consumer.
Clear warning on tariffs there from the Citadel CEO Ken Griffin speaking to Shonali Basak at the Economic Club of New York. Here's how the day ahead looks for you. Economic data, PMIs, US PMIs coming out at 9:45 a.m. We just had some brutal European PMIs taking the euro lower. Next up, you're going to have data. UMich, consumer sentiment at 10 a.m. And on the Fed slate, you have Michelle Bowman speaking a little bit later this evening at 6:15 p.m. Some micro movers for you. Ross Stores, the discount retailer, lifting its annual projections for its earnings per share, along with the results. They fared a little bit better than was feared. You have Tenet Healthcare. Hospital stocks extending the sell-off for the 8th day. This is pretty brutal. Again, under more pressure since President-elect Trump's election victory. Dr. Oz taking over health, and of course, what will JFK Jr. Do in his administration? So, steady play on a couple of those stocks. I want to leave you with a snapshot of what's going on with the bond yields. Obviously, the PMIs coming in much lower than we had anticipated. S&P futures are down 0.25%. So the European PMIs are down. Look at those bond yields dropping. US yields also fall ever so slightly. We'll have the PMIs for you later in the day. But that is where the pressure point was in the Eurozone, falling back into contraction on some of the numbers. That's it for Bloomberg Briefs. Venice will take you through the next couple of hours on everything you need to know. You never know, we might even get a Treasury Secretary announced later today. This is Bloomberg.
in 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money ×5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
I think we're renormalizing a yield curve if we've taken recession fears off the table.
As long as the underlying components and sort of drivers of inflation are still disinflation, I think it lets the Fed keep going.
They probably sneak in a cut in December, although even that's gotten to be a close call now.
I think that they can probably still go ahead and cut by 25 basis points in December, but next year is rather uncertain.
The objective has been to hold this soft landing, and now we're going to have melding.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
You've almost made it. Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with your equity market picture shaping up as follows. Equity futures on the S&P 500 down by around about 1/3% as we come into Friday, heading towards a week of gains without a single down day so far this week. Will we change that this Friday? On the Nasdaq 100, we're down by 0.5. If you want some fireworks, the wrong kind of fireworks, check out Euro-Dollar. Euro-Dollar earlier on this morning with a 103 handle, right now just about holding on to 104, 104.29. The latest out of Europe, growth revised lower in Germany, and the PMIs out of Europe this morning, pretty awful.
They were just terrible. If you look at France, the PMIs came in at the weakest since January. In Germany, the weakest since February, solidly in contraction. In France, below all expectations. Now the question is, how much weaker can it get? George Saravelos of Deutsche Bank said, we remain very bearish on euro, US dollar. Trump is only 30% priced, and this is the discussion over across the Atlantic.
And how much wider can spreads get across the Atlantic between Germany and the United States right now? If you check out the front end of the German curve this morning, we're down 10 basis points on a German 2-year. And the spread between the US and Germany back in September, about 135. Right now on my screen, 232. We are aggressively wider over the last month.
This is the right point, especially at a time where people are suddenly starting to price in a 50 basis point rate cut next month at the next ECB meeting. The question is, we've forgotten to talk about decoupling. People just sort of expect it to happen. And now the question really is, how wide can that division get at a time where there is a secular and and frankly existential question facing the Euro region that Christine Lagarde put out there? We're not keeping up with innovation, and secular stagnation very much on the table.
Let's make it really simple this morning. Just listen to the difference in the conversations in Europe and the conversations in the United States. In Europe, they're talking about a 50 basis point reduction in December. In the United States, Deutsche Bank's Matt Lazzetti saying that after December, this Fed's on pause for the whole of 2025. Why? Because of policies out of the United States. And we're still playing Game of Thrones. These are the names, you know them well by now: Walsh, Besson, Rowan, Haggerty, there's 4 on the screen. Wall Street Journal confirming something that Anne-Marie's been talking about all week. It's not Game of Thrones, it's potentially Game of Moving Thrones down in Washington, D.C.
Yes, exactly. The Wall Street Journal this morning on the front page, something that we've been reporting for a few days, and potentially this tie-up, which could see Kevin Warsh at Treasury coming into the Trump administration with Scott Bessent at NEC, and then when Powell is up and exits stage left from Fed chair in 2026, then maybe Warsh could go to the Fed, and then Bessent can ascend to Treasury, which we know that he's definitely in the running for. But this is just potentially one pair-up. We're still waiting on the final decision from President-elect Trump.
And really all this comes down to the same issue that we keep talking about with the division between Europe and U.S., which is all of these candidates are going to some degree, try to placate Donald Trump and his wish for higher tariffs and, frankly, an America First kind of agenda. How do they do that while keeping markets calm to the point of deficits, as well as potentially to the ideas that they have to put forward?
America First and Europe hurts. Euro dollar right now, 104. Coming up this hour, this is the lineup for you. We'll catch up with Dom Constam of Mizuho on the potential impact of Trump policies. We'll speak to James Lucia of Capital Alpha Partners on the President-elect's Treasury Secretary pick. And we'll catch up with Dan Greenhouse of Solace Alternative Asset Management on why he isn't worried about tariffs. We begin this hour with equities taking a bite out of this week's advance. Traders are weighing the potential impacts of a second Trump administration. Dom Constam of Mizuho writing, Trump unified government likely changes the dynamic around the Fed, rates, and the US dollar. However, it'll take time to be sure to what degree. Obvious first-order changes are that term premiums should be higher on higher net Treasury supply. Dom joins us now for more. Dom, good morning.
Good morning.
Word of the morning, divergence. How much divergence can we expect between the United States and Europe throughout the next year?
Well, probably a lot more, obviously. I mean, the main thing is obviously the impact, I think, on the dollar of the tariff policy, and it could be substantial. I think I would sort of say that there's believe it or not, there's a lot of logic to what the Trump administration is likely to do on tariffs in terms of balancing that with the fiscal giveaways as well, the tax cuts. But the key thing actually is to have a stronger dollar, because then you sort of ameliorate the effects on inflation. So basically you pass the instance of the tariffs onto the exporters, and that does mean a much stronger dollar versus not just Europe, but obviously Asia as well.
You said there's a lot of logic. Share that with us. What is it?
Well, I mean, the logic is basically if you just have a stronger dollar, your terms of trade kind of deteriorate in the sense that the consumer the consumer in the US will do relatively well versus the countries that are exporting to it. If you bring in tariffs, then you basically transfer that benefit to the consumer to the federal government, which is what the Trump wants to do, and then you give it back to the consumer through tax cuts. So that's a kind of a nice sort of circularity there. The only problem you have is sort of the politics around it. To the guys who are paying the extra tariff and not getting the benefit that they would otherwise get from the terms of trade improvement, are they getting the tax back to them? So if you are a big importer in Arkansas who does a lot of, is on a pension or getting tips in the restaurant, then, maybe you're okay. But if you are not getting those tax back and you're in the East Coast, you're not doing so well. So it's going to be a political issue, a redistribution issue. But that is some logic. What you don't want, by the way, is you don't want the dollar not to go up, because then if the dollar doesn't go up, you basically do have that very bad inflation growth trade-off. And so in a way, the dollar is the cleanest way of playing not just the tariff story, but this tariff fiscal sort of tax giveaway story.
That logic explains why the U.S.'s gain is everybody else's pain, in particular with Europe.
Yeah.
Can we take this a step further and talk about how this will actually keep a lid on U.S. yields, even with, fiscal profligacy, at a time when that sucking sound, as Mohamed El-Arian has talked about, has just all the cash moving into the higher yielding universe, which is the United States. You could see global bond funds completely dominated by U.S. bond funds over the past week with money coming in. Western Europe saw outflows from their equity markets. U.S. equities saw huge inflows. I mean, again, just absolutely a gravitational force, even with some of the concerns about fiscal spending.
Yeah, so, there are kind of two things. First of all, before this whole election thing, we have been in a world where yields kind of need to come down, even in the US. So, you know, I disagree with the idea that the Fed is not going to be cutting rates in 2025, irrespective. It's going to take a while to see the impact of all these Trump policies on the US economy. Meanwhile, we are in a restrictive stance, and the Fed is going to be bringing rates down. So the question is, where do you anchor the yield curve? So let's say you anchor it at 3% short rates. Then, you know, the longer run issue is what happens to the long end. And that then comes back down to how the US decides to fund the deficit, because the tariffs won't cover the deficit. You know, you're still going to have a very big shortfall. So how that funding takes place will affect the long end. And then meanwhile, if the rest of the world is, if you like, taking the burden of this tariff policy in terms of weaker growth, and you look at Europe and all the problems that they have, then obviously there will be a sort of a reach for yield elsewhere. And if we have a steep yield curve, a lot of the foreigners will come back and they'll be attracted to our yields again. You know, right now, we don't see a lot of foreign demand because our yield curve is inverted. So that's a problem. So you will actually end up getting lower yields anchored initially by a lower short rate, but you know, in the end, obviously, it's not going to come crashing lower to 2 or 3%. You know, they might hang out at like 3 to 4% for a while. So that's the kind of story I would see. You know, bull steepening, initially, and then eventually maybe some best.
So are you painting a picture where somehow the American exceptionalism is a self-reinforcing cycle, while there can be relatively low inflation and growth, while the rest of the world is just feeling a whole lot of pain?
Through the strong dollar, absolutely. I mean, the worst thing you could have is if you didn't have a strong dollar, and then basically you end up with a sort of stagflationary impact from the tariffs. So all the negativity around tariffs, to be honest, is because people haven't really counted in the fact that if the dollar gets very strong, the consumer is going to be insulated. All you're doing is you're not giving the gains to the consumer they would otherwise have from a strong dollar. You're handing it to the federal government, which is fine if they're going to hand the money back. So in a way, US exceptionalism is sort of, there, and the guys who are going to pay the costs are the guys who have the big surpluses. There's no way that you can have a sort of a protectionist tit for tat that is ultimately going to allow countries that anyway run a surplus with the US to actually disproportionately benefit from that. They're not going to do that. They're going to suffer at the end of the day, and that is the whole game plan here. Obviously, to say, look, we've carried this for too long, and we want to sort of get something back for it.
But aren't you expecting retaliatory measures like we saw in the first iteration when China decided to stop buying American agricultural products?
A little bit, and maybe they can do better if they can target very specific areas. That sort of kind of hurts, get more bang for your buck. But at the end of the day, if you're running a very large deficit, there's a limit to what retaliation can really do from the countries that run the surplus. I mean, that's a problem. So, and by the way, from a praise to optimality, this great economic concept whereby you can redistribute, stuff around everyone and everyone's better off together, that's absolutely true. The whole principles of comparative advantage are absolutely true. The global economy is absolutely worse off because of this. But kind of as an American first, who cares?
I guess my point is, in the first iteration, there was a massive bailout that American taxpayers paid for when it came to the farmers because of the trade war. When you say be more targeted, does that mean you expect the Trump administration coming in to be more targeted about what they're going to go after in terms of tariffs, not blanket tariffs?
I think that's very important how they, exactly. I mean, how they approach the whole tariff thing. I mean, if you combine it with the China and the universal tariff, then again, the giveaways, the fiscal giveaways back again are going to be very important to secure the political base. I mean, ironically, there was a Bloomberg article actually, because you can see who imports the most by state. And ironically, it was a good article, but basically showed that some of the red states really were going to be disproportionately hurt by these tariffs. And so you've got to be careful that, you don't hurt the guys there who are voting Trump. On the other hand, if it's all political and the swing states are going to be sort of better off, then kind of who cares? Because, Arkansas will never vote Democrat, but, Wisconsin, can vote Republican ongoing, then, net, that's the right political move. So
that's the politics. Let's finish on the markets. You talked about the importance of the US dollar. Is there a real risk that the deficit undermines the dollar's position?
I mean, I don't think so. As long as the Fed is willing and able to lower interest rates at the front end. So basically, you'll have, if you can have a steep, no one's, foreigners aren't really buying treasuries, let's be honest. They're buying mortgages, but they're not really buying treasuries. They will buy treasuries if they can steepen that yield curve. And in the end, if you end up having, much flatter yield curves in Europe and Japan, and of course, what does all this do? The ECB, how far can they take short rates? Well, only so far, and what's going to happen to the long end? Well, as you know, it's going to rally. So basically, in the end, you'll get foreigners back into our market. The important thing for the US, I think, and this is where the Fed chair replacement eventually comes in, is you need to anchor the yield curve lower by short rates. So whether they tell them to do that or the data falls the right way to allow them to do that in a credible way, either way. But you can always have the bill supply. I mean, at the end of the day, I think, you talk about the Treasury, who's going to be the new Treasury Secretary. It probably doesn't matter as long as they're very willing to increase the bill share of Treasury supply, and I imagine they will, and they'll do it quite substantially. And on that basis, you will end up with a relatively sort of lower yield environment.
You finished by opening the door to a much, much longer conversation about central bank independence and just how much cooperation there will be between these institutions. Dom, it's good to see you, sir.
Yeah, nice.
Thank you. Thank you very much. Don Constant there of Mizuho. Equities just a little bit softer this morning on the S&P 500. The highlight of the price action, the euro, dropping to 103. Levels we haven't seen since 2022 on euro dollar. Right now, 104.24. With an update on stories elsewhere with your Bloomberg Brief, here's Yahara Hakes. Hey, Yahara.
Hi, John. President-elect Donald Trump has nominated former Florida Attorney General Pam Bondi to run the Justice Department. The nomination coming just hours after former Florida Congressman Matt Gaetz withdrew from consideration for the role. Bondi is a longtime Trump ally. Meanwhile, Japan's core inflation rate remained above the central bank's target, coming in at 2.3% in October. The data supports the Bank of Japan's view that underlying inflation remains solid and may lead to a rate hike in the coming months. Japan's cabinet also approved a stimulus package totaling around $140 billion meant to support low-income households, subsidies for energy bills, as well as investment into the technology sector. And look at shares of Gap. Those are soaring up more than 15% in the pre-market. The retailer boosted its full-year outlook because apparently wealthier shoppers are seeking value. The owner of Old Navy and Athleta now sees sales up 1.5% to 2%. That's up from less than 1%. Gap also telling investors the company's brands are growing market share across categories and said it was the 7th straight quarter of gains. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, searching for Donald Trump's perfect Treasury Secretary.
The president knows, the president-elect knows, getting the right person is more important right now than getting the pick done today or tomorrow.
That conversation up next, live from New York this morning. Good morning.
We spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Europe looking ugly this morning. Euro dollar specifically. Europe's always beautiful, but the euro looking ugly this morning. 104.20 before I start getting hate mail. 103 briefly earlier on. German growth revised lower. The PMI's just awful out of the Eurozone today. We'll break through the individual components of it in just a moment, but not great at all. A weaker euro on the screen once again. Under surveillance this morning, searching for Donald Trump's perfect Treasury Secretary.
He ran an economic agenda campaign. This is in his opinion, this is one of the most important, if not the most important pick he is going to make. So getting it right is important. The president knows, the president-elect knows, getting the right person is more important right now than getting the pick done today or tomorrow.
So here's the latest this morning. The Wall Street Journal reporting that Donald Trump is considering former Federal Reserve Governor Kevin Warsh for Treasury with an understanding he could later be nominated for Fed chair when Powell's term ends in 2026. James Lucier of Capital Alpha Partners writing, we will likely see a free trader at Treasury, whether it's Warsh or Besant. The one who doesn't get Treasury will get NEC. Markets would prefer Besant, in my view, a serious financial markets guy who also speaks MAGA. James joins us now for more. James, before we get deep into this, I want your reaction to that Wall Street Journal story. It's something Anne-Marie's been talking about all through this week, that if he selects Kevin Warsh, it really is the appetizer for the main event for Kevin Warsh, which would be Fed chair further down the road. Do you think that is sort of reasonable from your standpoint? Is that what you'd expect?
I do think that's reasonable. And the Wall Street Journal is reporting what a lot of people have been thinking for a while, which is that we have a very narrow group of people we're looking at. Besant was the front runner. Warsh is coming up. It'll be one or the other. And it would be a very Trumpian compromise to put Warsh in the Treasury spot with the promise, if he follows through in that promise 18 months later, that he will rotate Besant into that position. You know, it reminds me of the Treasury switcheroo between James Baker and Donald Reagan back in the Reagan days.
James, though, if you put an individual at the Treasury who really wants an end game, his job at the Fed, does that compromise how the markets view him as a Treasury Secretary?
Well, it does. That's why I think the market would be more comfortable with Besant, but that's not the way Trump thinks. Two key principles about Donald Trump. One is proximity and timing. He can be, lobbied that John Farrow needs to be Treasury Secretary, and then someone walks in and says it's got to be Lisa, and he'll say, yeah, let's go with Lisa. So there are those surprising moves, but he also gets frustrated if he has a list of people that he's not entirely satisfied with. And I think that's what we're seeing at Treasury. The lobbying from Lutnick, from the MAGA community, that maybe Besant wasn't a sufficiently hard liner on tariffs. So Trump is frustrated there, and so he's looking at other alternatives. Maybe Warsh is that other alternative for now.
You did note in your notes, though, that Besant speaks MAGA. And I will say, yesterday we heard from the Bannon War Room really backing Scott Besant. This is an individual who has Steve Bannon and Steve Schwartzman lining up behind him. Who else in these names we're talking about has the MAGA base, and also individual on Wall Street calling President-elect Trump saying, that's my guy?
It's hard to say. I don't really think that Mark Rowan has a MAGA presence, so to speak. It does help that Steve Bannon is coming out for Besant after Elon Musk came out against him, and after Howard Lutnick came out against Besant as part of a contest for supremacy, a contest to get that top job, which Lutnick wanted badly. I'm frankly going to be very surprised if Lutnick is satisfied with being Commerce Secretary. So, unless somebody comes in out of the blue, it'll be one of the two. And while I did say that Besant seems to speak MAGA more fluently, Warsh does have a long history going back with Donald Trump, that Warsh might have had Jay Powell's job, and Trump has actually remarked reportedly to Warsh that, I should have picked you instead of Jay.
Just like Game of Thrones, there are different threads. So there's the Treasury Secretary battle that's going on one hand, and then there's the issue of the rest of the cabinet picks, with yesterday Matt Gaetz withdrawing his nomination to become Attorney General. What do you make of that withdrawal? I mean, putting aside some of the other cabinet picks and Pam Bondi, who has been selected to replace him, what's your takeaway from how this moves the chips around in the battle for what you call a revenge cabinet?
Well, the takeaway is that when Trump gets bored, he starts reaching out in new directions. I think the reason he picked Matt Gaetz to begin with is that too many of the establishment conservative Federal Society type lawyers he was presented with probably reminded him of Bill Barr. So he wanted somebody different, and that's how Gaetz got it. Now, Pam Bondi is a classic example of someone that Trump would be comfortable with, given that she is a Floridian, given that she's been a staunch defender of his, literally to the point of being his defense attorney during the first impeachment trial. Plus, you know, she looks great on television. She's a very attractive woman, and that's something that Trump likes as well. But, you know, she was elected statewide as Attorney General, the first woman Attorney General of Florida. So I think that from a MAGA perspective or a Trump perspective, she is a great pick. I distinguish the controversial nominees, the C5 that originally began with Gaetz, Hegseth, Tulsi Gabbard, Robert F. Kennedy, Kristi Noem. All of these people are cabinet secretaries dealing with agencies where Donald Trump felt deep frustration, where he felt the deep state was moving against him. So you could say these controversial nominees are literally his personal revenge against those guys. I think the other cabinet picks are very, very exciting in that most of these people, like Lee Zeldin and EPA, have no prior connection with the agency they'd be running, but they're there to shake things up, to dogify the government, to bring a fresh breath of air. And I think the others are probably great. Watching now to see what Pete Hegseth does, whether Hegseth can hang on and survive, because a lot of people, frankly, thought that he would go before Gaetz did.
James, a lot of people are saying, okay, so what kind of experience, just like you said, do these people have other than being on TV? And let me just tell you, that's real experience. So if you want to put ourselves forward for a potential selection, go for it. But there is this real question about the necessity of having spokespeople in these seats to really advertise what's going on. And actually, one of the big criticisms of the prior administration was people didn't hear from them about what was going on quite as much. How much is that actually a linchpin of Donald Trump's strategy?
Well, I think things have changed this time, and that Donald Trump has had 3.5 years to sit around and stew about the failures and disappointments of his first term. For many issues in the first term, there were really no decisions made until late in the term. Decisions about what the tax reform would look like, an incredibly important decision for Trump. Decisions about the EV mandates, decisions about EPA regulations, decisions about whether to stay in the Paris Agreement. In short, they were slow to make the decisions, and they had people who didn't have a game plan when they went to the agencies. This time, I think they've made many decisions in advance. They've got a checklist of what Trump wants to do and what Trump wants to change. And while we've got good communicators in the role of top person at these agencies, I think this time there will be sort of the number two, the deputy secretaries, the backup people who do have a plan to execute on and a checklist. And they're going to take names. We'll probably also shoot first and ask questions later, figuratively speaking, of course.
Hey, James, appreciate your time. Thank you, sir. James Lucy there of Capital Alpha Partners. If the president-elect is watching this morning, I know sometimes he tunes in. Good morning. I've got 2 points to make. One, we need Lisa right here. And two, the news conferences would be terrifying. They'd be terrifying. Can you imagine what they'd look like with Lisa as Fed chair?
Okay, guys, we are so
1
worried
hour.
about the
We're
deficit.
screwed.
We're just absolutely screwed. This trajectory does not work at all. I'm just waiting for the vigilantes to march in Washington, D.C. Everybody, get your packages ready.
Would that make you the most dovish central bank chair ever, though?
I don't know.
Would you accompany that with zero interest rates and QE forever?
No, because then that would cause inflation to rise.
So you'd
and
be
I'm also
like
worried about inflation.
5% sort the deficit out.
Yeah.
The problem's on you.
100%.
See? Bramo's going nowhere. Coming up next, Dan Greenhouse of Solace Alternative Asset Management. Frankly, I'm offended. From New York, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Still just about heading towards a week of gains on the S&P 500. 4 days and no losses so far this week. On the S&P at the moment, pulling back a touch. We're down 1/3% on the S&P 500. On the Nasdaq, we're down by 0.4. In the bond market, 2-year, 10-year, 30-year, just a little bit of a rally at the front end of the curve. We're down 2 basis points, down 3 on 10s to 439. A bigger rally out of Europe this morning. Check it out. Front end of the German curve. German 2-year, down by what, 10 basis points to 2%. The euro, a whole lot weaker, briefly 103, euro dollar right now 104.22, and a real conversation this morning about whether the ECB needs to reduce interest rates by 50 basis points next month.
Just to put this in a perspective about how quickly that thrust is coming to the fore, today there is a 50% chance of a 50 basis point rate cut at the next ECB meeting. Yesterday it was 15% chance. Basically, the PMI data out of Germany and France has altered the conversation to really necessitate a faster speed for the ECB.
In 1 hour from now, we'll catch up with the Portuguese Central Bank Governor, Mario Centeno. Look out for that conversation. A man who's arguably actually been ahead of the curve relative to some of the other officials on the Governing Council. So that's worth a look in about 60 minutes' time. Under surveillance this morning, let's talk about that data out of Europe. Germany's economy expanding less than initially reported in the third quarter. The country's statistics agency saying GDP rose just 0.1% in the 3 months through September, down from a first estimate of just 0.2. A drop in exports holding back growth. Put that together with the PMIs out earlier on this morning, and the picture really isn't great.
It's secular stagnation. And Christine Lagarde, the head of the ECB, coming out and basically saying, since last year, Europe's declining innovation position has come more clearly to light. She's talking about the Draghi report almost, and echoing some of the necessity for there to be some sort of industrial plan, but also something to ignite competition. It just is unclear how quickly they can get that back to the fore to stave off some of the sucking sound that you hear of capital away from Europe, which you're seeing in the flows this week, and toward the United States.
She also is basically saying what we've been talking about this entire year on this program, was that the technology gap between the United States and Europe is unmistakable now. And then she's pointing to what's on the horizon, this geopolitical tension that is going to make the situation in Europe so much more difficult.
Let's turn to the eastern part of Europe and get you an update on some of the Middle East. We'll be talking about Ukraine and the latest with Russia a little bit later on the program, so look out for an update there. I want to stick on some of the wars elsewhere. Unfortunately, we need to talk about this one. Israeli Prime Minister Benjamin Netanyahu saying he won't back down in the war against Hamas in Gaza. His comments coming after the International Criminal Court issued arrest warrants against him and a former minister. Netanyahu calling the move anti-Semitic.
So the United States is basically rejecting the court's authority, and they do not agree with this. They say the ICC issuance of arrest warrants against Israeli leaders is outrageous. That came from President Joe Biden. And then incoming President-elect Donald Trump's national security advisor, Michael Waltz, went on Twitter and basically said you can expect a strong response. So you see the United States going against the ICC. It's not a signatory of it, but this is a remarkable moment because you also see how hawkish Trump is going to be when it comes to making sure that the United States is standing behind Israel.
It also harkens to what David Malpass was talking about, which is that there's been a breakdown of some of these international agencies where you really are not able to hide the dissent and the lack of some sort of coalescing around a stance. ICC's view, Hungary's prime minister inviting Netanyahu to Hungary, even though ostensibly he should be arresting him. The expectation that maybe he'll get the same in other places. Australia denying to one of the Israeli ministers. But here is the question. What is going to be the relevance of some of these agencies in 5 years, 10 years, if you don't have some sort of gravitational force that their credos really hold in the entire world?
To your point, Lisa, increasingly losing relevance over the last few years, and that process seems to be accelerating over the last year alone. Let's turn to President-elect Donald Trump's search for Treasury Secretary. It continues. The Wall Street Journal reporting Trump is leaning towards former Fed Governor Kevin Warsh for the role, with an understanding he could later be nominated for Fed Chair when Powell's term ends in 2026.
So everyone wins in this scenario, and we actually reported about this earlier in the week, that potentially individual Donald Trump saw this as a solution to what they were dealing with, when at the moment then it was Howard Lutnick and Scott Bassett fighting for that role, bringing Kevin Warsh, who the president knows, who also has been a voice in the transition on economic policy. He can take that spot for a year and a half. Scott Bassett is still in the room with the president, would be in the West Wing, someone he really knows very well, who's been on the campaign trail with him. But let me tell you this, the president hasn't made a decision, because if he did, we would all be talking about it. He has not made a decision, and yesterday the transition team was clearly preoccupied with what happened with this fallout of Matt Gaetz and having to move the conversation for a different AG. 8 days, 2 AG picks, not 1 Treasury Secretary pick.
And we're still waiting. And if this happens, if this Wall Street Journal story materializes, we have to talk about the conversation that Dom Colston opened the door to earlier this hour. How much cooperation will be needed between Treasury and the Federal Reserve in the next few years?
Well, and Dom mentioned something else. He said that the likelihood that whoever comes in and is the Treasury Secretary needs to keep doing what Janet Yellen's been doing, which is to front load Treasury issuance in the bill space, essentially not necessarily pressuring that long end of the yield curve, which is the opposite of what we've been hearing from a number of people who are the picks potentially. So you have to wonder how coordinated of an effort it is. Stay tuned to Monday.
That's quite a tease, Bramo. Looking forward to Monday. Is that to get people to tune in on
I don't know.
holiday
That's
shortened
what it feels
week?
like. I feel like there needs to be like a voiceover.
Is this a Sunday night
for
decision, do you
everything?
think?
I think maybe.
Well, you nailed it yesterday when you said Donald Trump is a producer. He is literally producing the picks. He wants them to be at a certain time of the day. You talk about it in the morning. I think potentially with a Treasury pick, maybe they're going to not do it during market opening hours. I'm not sure, but
Friday 5 p.m. feels like a graveyard for news, but who knows? Maybe it will be a little bit later. I've got no idea. Let's turn to the markets. Weighing the potential impact of President-elect Donald Trump's policies, including tariffs, Dan Greenhouse of Solis Alternative Asset Management isn't concerned, writing, "I'm less worried about trade, tariffs, immigration than most others. Perhaps there's a tinge of wishful thinking on my part, but I'm not as convinced those policies, coupled with the tax cut extension, is all that bad for the US, certainly in the medium term." Dan joins us now for more. Dan, good morning. It's good to have you back.
Good morning. Thank you for having me back.
Is it bad for everybody else?
Well, certainly on the immigration front, it's bad for some people. I think the point that I'm making is on the tariff front specifically, I go to these dinners, I go to conferences, you speak to people, and the tariffs are universally viewed through a negative lens. They're inflationary, they raise prices, they punish consumers, particularly at the low end. There's an element of truth to all of that. I think where I differ is, A, we've seen this movie already. We had tariffs during the first Trump administration, and I think you'd be hard-pressed to find in consumer data a meaningful reaction to it. Obviously, goods prices, which were in a steady decline, stopped going down. Even though headline CPI showed no real influence, goods prices, which are the items obviously most affected by the tariffs, did stop going down and reverse course a bit. But I don't think you saw meaningful negative reactions throughout the economy. And part of the reason is into point 2 I wanted to make, which is if the currency adjusts, you can make a case, and I'm sure the Trump administration will, that there may not even be any price adjustment, and tariffs actually will be paid by the exporting country. And again, that's a bit of wishful thinking on my part, but I think it's a differentiated take.
So we have to talk about some risk more broadly, but I think the deficit is a big focus. So the dollar is at the epicenter of all of this. If the dollar remains strong, a lot of people are going to agree with you. It can offset some of the pain. If you start to see some cooperation between a Fed chair and a Treasury secretary to keep rates low to accommodate a bigger deficit, is the dollar going to be robust, or does the dollar get sold?
Well, I think, currencies are a winner-loser situation. I mean, you in the intro tease, you were talking about Europe. I don't think the euro the euro area is looking particularly strong right now. By extension, the euro itself is not looking particularly strong. But I also think it's a bit premature to be talking about that when we don't have a Treasury Secretary and we don't know who will be the...
True, but is the market getting ahead of it? And maybe not in traditional foreign exchange markets. Is that what we're seeing take place in gold, in Bitcoin, more recently?
Yeah, I think probably the deficit and the worries about inflation are manifesting themselves in gold somewhat. Bitcoin's, I think, a bit of a different story, because this is going to be the Bitcoin presidency, or insert whatever phrase he wants to have a cabinet level position focused on Bitcoin and crypto. So I think there's a lot of enthusiasm and front running in a sense in the Bitcoin market. But listen, there's clearly concern about the deficit. My rebuttal on that topic is the same, and we've discussed this in the past, is I can find you headlines for 40 years of people concerned about the deficit, and here we are 40 years later, and we've had virtually no impact whatsoever.
There's sort of a larger point here, though, which is, are there limits to this grand plan that everybody can see and that essentially would benefit the U.S. to the detriment of the rest of the world, whether it comes to retaliation, whether it comes to people saying, all right, we're going to stop financing your fiscal expansion because we got to do it back home?
Well, listen, I think if you told the current administration or the incoming administration that the sum total of these policies would benefit the U.S. at everyone's expense, I'm not sure they would care, since that is, in effect, the desired outcome. This is a core tenet of the Make America Great Again platform. Are there limits? Of course there are limits, but I again refer to my earlier statement. Is 30 trillion in debt worse than 25 trillion in debt? Sure, but show me the evidence where the market cares. Is that worse than 20 trillion in debt? Sure, but show me the evidence. Listen, there is a limit, but I think in a standalone economy with able to print its own currency, et cetera, and this is true around the globe, you have less external constraints than you do if you are not fitting into those categories, and the U.S. fits into the former.
Can this happen all without inflation really taking up in a meaningful way in the U.S.?
Well, let's define inflation, and I think it's important for viewers and for when we think about this. The boogeyman is the 9% level inflation, of course. I don't think that's likely at all. I don't think the conditions are anywhere in place for that level of inflation. But if you told me that inflation is going to get stuck and is in the process of getting stuck in the 2.5% to 3.5% range, I think that's more than likely. I think that's probably your base case outcome at this point. The question becomes, does the Federal Reserve, does the Treasury, does the government do markets care about inflation, not at 2%, but at 2.5% to 3.5%? Most of those categories, I think, don't care. I think you'll have a lot of market strategists come on here and say, if you told me we're going to get all these great policies, or the policies will have all great outcomes, but inflation is going to be stuck at 3% instead of 2%, I'm not sure any market participants will come on here and say they care.
Dan, do you think the market cares about the face that's going to represent all these policies? Who's going to be the Treasury Secretary?
Yeah, absolutely. I mean, there's not a person on Wall Street right now not hashing out these different names. I don't necessarily have I don't want to express a personal preference on air.
But you have one.
Listen, they're all great qualified candidates, and I think we would all be terrific with any one of them.
I've been saying the same thing. Oh, wait, just in case I offend someone.
I, for one, welcome our coming Treasury overlords. But listen, I think clearly Kevin Warsh appears to be the front runner. You mentioned the reporting earlier. You talk to people around the street. I think maybe he is seen as the most down the middle, if you will, candidate of all the people mentioned. But Scott Bessent and Howard Lutnick also. I mean, Howard obviously is favored by the crypto camp. There's a number of people who prefer Scott Bessent.
He's out, though.
I'm sorry?
Howard's out, though.
Because I'm sorry, you're right, because I've forgotten it's 6:30 in the morning, not 7. And I forgot he's at Commerce now. But all the people being discussed, I heard Larry Kudlow's name thrown around a couple of times.
He doesn't want it.
I think all of these outcomes would be pretty good for market. There's not to be blunt, there's not a Matt Gaetz level Treasury Secretary being discussed that's not broadly palatable.
These are high caliber candidates. We've said that repeatedly all week. Can we just finish up by talking about valuation constraints across the board? In equities, much has been talked about the forward multiple north of 20, going on to the 2025 on the S&P 500. Credit, a space that you know well. Goldman said this on credit. Barring a sell-off between now and year-end, investors will likely enter 2025 with the most severe valuation constraints in more than 2 decades. Worth noting, that doesn't make them bearish, by the way. They think this market will still be supported. Where do you see the support coming from in 2025?
I had that's Lotfi. I had dinner with him actually last night. Goldman hosted a dinner. I was lucky enough to get invited. I think, not to make Lotfi's point for him, but I think, listen, you have high starting all-in yields in credit, 7% plus for the broad index or so, which is a pretty good starting point. But so that by itself is attractive for yield-seeking investors of all stripes. But to take the credit overvaluation or high valuation argument and the equity valuation argument, and let's just do equity because most investors are the point is broadly the same. We're at 21 times forward earnings or something like that. Fine. Why can't that go to 22? So if we're going to earn $300 next year, let's just say these policies end up being pretty positive, and you earn $305, $310, and the multiple expands 1 turn. I can get you to 7,000 in the S&P next year pretty easily. In credit, you're starting at 7% all-in yield right there. These policies work. The economy does well. Defaults remain low. Spreads tighten to all-time tights instead of near all-time tights, and you've got low double-digit return for credit next year. So I think a lot of this depends on how the economy performs. The number one input into any equity valuation model will be domestic, if not global growth. And as long as the economy holds up, I don't know why. Listen, valuations are elevated. We know that. And a disproportionate share of that valuation is being driven by the tech stocks being a larger share of the market right now. But if the economy continues to hold up, you're going to see this broaden out. You've already seen it. A host of the names that some of our best performing names are non-tech related this year. They're consumer focused. Some of the energy space has done well. Obviously, healthcare is having problems now. But before that, there's a lot of opportunity here, assuming the economy continues to grow and profits continue to grow. And I wouldn't spend too much time worried about valuations until it's time to worry about valuations.
We'll spend a lot of time worrying about valuations. Don't worry. Dan, it's good to see you. Dan Greenhouse of Solis Alternative Asset Management at 6:45 Eastern Time in the morning. We get very lucky. Thanks for waking up.
Thank you.
30 minutes earlier than usual. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Bill Wong's 18-year prison sentence could be reduced to 11.5 years. This after his lawyer argued the punishment was too harsh for the founder of Archegos Capital Management. Wong's lawyer urged the judge to let his client serve 6.5 of the 18 years in home confinement instead of behind bars, and the judge said he would consider the request. Meanwhile, Pennsylvania Senator Bob Casey has conceded to his Republican opponent, David McCormick, in a race that was so close it triggered a recount. McCormick was declared the winner by news outlets earlier this month, but the state ordered the recount because the margin was under 0.5%. Casey had held his Senate seat since 2007 and now cedes to McCormick, who before this led Bridgewater for more than a decade. And DirecTV is pulling the plug on its Dish takeover. DirecTV has notified EchoStar of its intention to terminate the acquisition. This after it failed to win the consent from bondholders for a keep debt exchange. The deal would have created one of the largest pay TV distributors in the U.S. with a combined 18 million subscribers. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in 30 minutes. Up next on the program, escalation in Ukraine. Live from New York, this is Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we we have enough information to know exactly what something is going to be worth in terms of insuring it or not.
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Live from New York City, equity futures right now down by almost 1/3 on the S&P. Bond yields lower by 3 basis points, 4.39. The euro a whole lot weaker. Really, really big downside surprises across the eurozone. Not just today, just across the board really. Over the last few months, euro dollar down to 104. Under surveillance this morning, escalation in Ukraine. Here's the latest. Russia conducting another drone attack on Ukraine this morning after using a new experimental intermediate-range ballistic missile just yesterday. Putin calling the attack retaliation for Ukraine using American and British-made missiles on Russian territory earlier this week. Bloomberg's Ollie Crook joins us now for more from Berlin. Ollie, good morning to you, sir. What's the latest?
Yeah, that's right, Jonathan. We heard directly from the Russian president yesterday saying two things. One, that explicitly this was retaliation on the use of U.S. and U.K. long-range missiles within Russian territory, a concession that Joe Biden gave earlier this week. And saying, second, that this is not an accident that this is happening right now, right? This is the week in which we've heard a new nuclear doctrine from the Russian president saying that he is sort of ready now to diminish the level at which it would be appropriate for the Russians to strike back with nuclear force. There has been a question about whether this was an intercontinental ballistic missile. The end of the story is here. This is a missile that traveled 1,000 kilometers from the Caspian Sea into Ukraine at a time also when it seems like Putin is ready potentially to come to the table and talk to President-elect Donald Trump about potential ceasefire negotiations. So it's very hard to distinguish how much of this is an organic escalation of this conflict, how much of this is both of the sides trying to get in a stronger position in order to have a stronger hand at the negotiating table with the great unknown of Donald Trump. We've heard from the Kremlin this morning saying we are in no doubt that the current administration in Washington has had the chance to familiarize itself with this announcement and to understand it. We should also say, however, that we understand from the Pentagon that the U.S. was alerted that this missile was going to be fired minutes before it was launched. We should also say, though, this has been a conflict that hasn't really moved the markets widely over the last few weeks. That changed this week. We have gold up almost 6% this week.
Started to see some moves this week, that's for sure. Ollie, thank you, sir. Bloomberg's Ollie Crook out of Berlin with the latest. A week full of escalation. To continue the conversation, Liana Fix of the Council on Foreign Relations joins us now. Liana, welcome back to the program. Let's talk about the prospect of some kind of deal and whether President-elect Donald Trump can broker one. Is this making it harder or easier to broker a deal when he takes power in 2 months' time?
So the Trump camp has been very unhappy with Biden's decision to allow long-range strike missiles into Russia. But let's remember that this is a response from the Biden administration. This is a response to a Russian escalation, the North Korean troops in Russia who are fighting against Ukrainian soldiers. And the problem for Vladimir Putin in this situation is that he has a new nuclear doctrine, but that by now no one really believes his red lines anymore because he has overstepped so so often, and the more he lowers the threshold, the more difficult it will be for him to uphold credibility. That's what he's trying to do now, uphold credibility with a view to a new Trump administration coming in and potential talks. He wants to be seen as Trump as a strong nuclear superpower.
How quickly do you think we could see those talks once President-elect Trump is in office and gets his team in place?
Well, Trump might actually be surprised that it is not that easy to just based on his personal relationship with Vladimir Putin to get him to the table. There is no indication whatsoever in the Russian discourse, in the discourse around the Kremlin, that there is a willingness to make any concessions. So Putin will come to the negotiating table expecting capitulation. He is on the advance. He has the manpower advantage right now. But if Trump doesn't want to be the one who loses Ukraine, similarly, like Biden had this humiliating withdrawal from Afghanistan, he cannot allow a capitulation. So it might actually be much easier to negotiate, much more difficult to negotiate for Donald Trump with Vladimir Putin than he thinks right now.
If Moscow and Kyiv both know that they may at some point be forced to a negotiating table, how bad is it going to get in terms of the physical war on the ground?
Yeah, obviously Russia is trying to get the advantage right now, and they have all the means to achieve that. But what they want is they want to reach the borderlines of the 4 districts that they claim to have annexed in Ukraine, but don't really control. This is the minimum goal that Vladimir Putin wanted to achieve. So this is something to look out for. And on the Ukrainian side, obviously, they will be in need of a new support package at the beginning of next year at the latest. If that support package doesn't arrive under Donald Trump, it will be much more difficult for Ukraine to hold the line.
Leanna Fix at the Council on Foreign Relations on the latest. Leanna, I appreciate your time, as always. After a series of escalatory steps with regards to this war, started really a few months ago with reports that North Korean troops would be getting involved. It went from there to what we've seen over the past 2 weeks.
Absolutely. There's been a tremendous amount of escalation. All of this is leading up to a change of power, a transforming of power in the United States. And what does that mean when you have President Biden giving Ukraine something they've been begging for? The United States has been dragging their feet and allowing them to hit into Russian territory. At the same time, though, you have a president coming in that says, I want to end this war. So now you're going to have a tremendous amount of escalation because everyone wants to go into this potential negotiating table with the best hand they can play.
So what do you make of the question that we started the conversation with? Does it make it harder or easier for the president-elect to broker the deal that he'd like to broker?
I think it really depends on when he comes in, what is the status of the war on the ground. I would say you have to look at some recent polling in Ukraine that shows, especially among the younger generation, they are almost tired of this war. They are the ones that are going to the front lines. They are the ones that are losing their families, their fathers, their brothers. And that might put more political pressure on Zelensky, even more so than President-elect Trump.
Yeah, they want to end this. Coming up next on the programme, we'll catch up with Mohammed Al-Erin of Queen's College, Cambridge. We'll speak to Maya McGuinness of the Committee for a Not-So-Responsible Federal Budget. ECB Governing Council member Mario Santino on the latest data out of Europe. And we'll speak to Raj Agrawal of KKR. Looking forward to a stacked hour still ahead.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are 3 fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more. It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
We're still bullish on the U.S.
You've seen massive outperformance from U.S. assets here. Over the next few months, what we're going to see is continued outperformance of U.S. equities over the rest of the world.
I think Trump is going to care as much about the stock market these next 4 years as he did the first 4 years.
The bond market will call the tune for the stock market as well.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City. Here's your price action on the S&P 500, down just 0.1%, a marginal move lower on the S&P, a mild move lower on the Nasdaq 100. We're down by 0.25%, a big move lower on euro dollar earlier on this morning. 103 briefly. We're talking about levels we haven't seen in almost 2 years on the euro against the US dollar, 104.20, and the Y is very much in Europe. The Y is bad data.
It's bad data coming out of both France and Germany, PMIs, private sector activity, business activity, falling deeply into contraction, into some of the lowest levels that we've seen since the beginning of this year, at a time where you already have weakness being priced in. Now the question is, it's not just an economic issue, it's how far can the ECB cut rates at a time where divergence is so much back on the table.
How far and how quickly? We'll have a conversation with a ECB official in about 30 minutes from now. And that's where the conversation will begin. Is a 50 basis point cut on the table next month? Beyond that, do you have to rethink the process of normalizing and start to think a whole lot more about becoming accommodative? Is the risk now moving away from inflation and towards disorderly disinflation, something that Deutsche Bank's been talking about now for quite a while?
So we have a response to those questions from ECB Vice President Luis de Guindos, who said, you know, it doesn't really matter, 25, 50. It's less important. It's the trajectory, which is lower, a lot lower. We need to get there quickly. And that's basically what the market's been pricing in. 50 basis points now the base case for markets that are looking for some serious action. And maybe Mauro Centeno can weigh in on that, because he's been actually ahead of the curve.
He has been, in a big way. They're stuck between a rock and a hard place. The rock is the domestic European data. The hard place is what could be coming in the next 12 months from the US administration. And we'll get more clarity on that, I think, in the next several days, once we know who the Treasury pick is going to be. You all know the names. I'll repeat them once again. Bessent, Walsh, Rowan, Haggerty. Who's it going to be?
Well, we're hearing musical chairs when it comes to this Treasury pick. Potentially, we're going to get the name today. Yesterday, it seemed like the transition was really sidelined, dealing with the Attorney General. Wall Street Journal today has something that we have been talking about for days and also reported on, that potentially a solution to a problem could be putting Walsh at Treasury, Bessent at NEC, and then in 2026, moving Walsh to really his end game and goal in life, which is Fed chair, and then pushing Bessent to the Treasury. Treasury. This is potentially one duo we could see, but Donald Trump has yet to make a decision. It's only $28 trillion of debt this individual's in charge of, so, you know, I think he's taking his time.
Imagine how messy this could be, because it could be quite messy. We've had a conversation about the potential of having the shadow Fed chair. We would basically have one. We would know who it would be if they go forward with this plan and talk about it publicly. We would know who it would be, so we would put that much extra weight, I think, on every single word that would come from the Treasury Secretary, with the idea being that they'd be in charge of monetary policy just around the corner.
The line between the Fed and the Treasury has gotten muddier and muddier over the years, especially with the likes of Janet Yellen being at the Fed and then moving to the Treasury. Think about if you know it is going to be the same person in the same administration at a time where the strategies are so aligned. This is going to be in the history books a time where people look back at the U.S. experiment and say, how do you use fiscal dominance to exert the pain on everybody else while continuing to consolidate the gains in the United States with tariffs and not necessarily allowing rates to go too high?
Part of the reason we've got gold and Bitcoin at or close to all-time highs. Coming up this hour, we'll catch up with Mohamed Al-Erna of Queen's College, Cambridge, on the next Treasury pick. We'll speak to the Portuguese Central Bank Governor, Mario Centeno, on rising bets for a jumbo rate cut by the ECB. And we'll speak to Raj Agrawal of KKR on the big spend needed to power AI. We begin this hour with stocks inching just a little bit lower and Treasuries rallying. Markets still waiting for President-elect Donald Trump's Treasury pick. The three front-runners remain the same: Scott Bessent, Kevin Warsh and Mark Rowan. Mohamed Al-Erna of Queen's College, Cambridge, saying this on one of the picks: Kevin Warsh's professional career and writings would make him a strong presidential choice for Treasury and for the Federal Reserve. Mohamed joins us now for more. Mohamed, are you endorsing a candidate then in this race for Treasury?
What I'm saying, John, of the four, the one that I have followed most closely is Kevin Warsh. I've done that for almost 2 decades. And if you look at what he would bring to either or both jobs, first, a good understanding and knowledge of economics. You're talking about Stanford, Harvard, MIT. He would bring policy-making experience, the NEC and the Fed. He would bring private sector experience. He understands the functioning of the capital markets. It's not often that you find someone who can operate at this intersection of economics, finance, and policy. And it's not often that you find someone who not only can operate there, but can communicate well. And we do need much better economic communication.
Mohamed, I've said this a few times, and I'm sure you'd agree. It's good news that the caliber of all the candidates is so high, given the challenges they'll have to confront in the next several years. As we look ahead to 2025, could we go through a few of those challenges right now? What do you think the biggest are for the incoming Treasury Secretary?
I think it's maintain economic growth. John, I can't stress how important that is. It is important to deal with problems of inequality. It's important to deal with the debt issue. The best way to address a debt issue is through economic growth. And we are looking at a major transition, which is ongoing, from old engines of growth to new engines, or what economists call the old model of growth to the new model of growth. And the Treasury Secretary will be the lead person in figuring how we navigate all this.
Mohamed, if it is someone like Kevin Warsh and everyone knows his end game is the Fed, does that blur the line of Fed independence?
I think you summed it well, that line has been blurred before. But I suspect that if Warsh gets the job, he's going to be really careful as to what he says on monetary policy. He will respect that line. It's also not clear that the president-elect will commit to a second step for Kevin Warsh. I suspect that he will say he will keep his options open. So I don't worry about that, Anne-Marie. I just look at Kevin as someone who, both as Treasury and Fed chair, I think would do a really good job.
If this drags on, we were supposed to get a pick yesterday. If we don't get one today, if this continues to drag on, Gary Cohn reminded us all yesterday that his pick, his nod, and also Mnuchin's nod came after Thanksgiving. Is that in itself a market negative, given the fact that we have all these other nominees floating around for the incoming administration, but we don't have this one key name for the markets?
Yeah, I thought Gary's interview with you yesterday was really good because he said two things. One, as you just mentioned, he said, look, I didn't find out till after Thanksgiving. And then the second thing he said is, look at what we inherited then, including some unanticipated development compared to what the new team will be inheriting now. So I don't think it's a market negative. I particularly don't think it's a market negative because, as John said, there are credible candidates being considered, or so we're told. So no, I don't think it is a market negative. I think it's the right thing to take time to make this decision.
Mohammed, I thought of you a lot this morning when I saw the flows for the past week into bonds and stock funds in the U.S., and I saw the outflows, the dramatic outflows from European bond and stock flows, and I thought about your comment about that sucking sound of capital away from the rest of the world and into the United States, and I have to wonder, are there limits to this? Because basically, the fact that everybody else's pain is leading to the U.S. gain is also leading to higher rates that the rest of the world is going to pay for. In other words, they're going to pay for that debt because of the attraction of interest rates. When does that kind of balance out? Do people get sick of this story?
Not for a while. And I thought of all three of you because I remember when we were together last week and we talked about the global economy, and I told you the good, the bad, and the ugly, and I put Europe in the ugly, saying there really is an issue there that as both secular and cyclical headwinds come together. And today's PMI numbers are a clear reminder that there is this problem, and it's getting deeper. We know what the solutions are. There is the Draghi report, but there is no political will to implement it. So the U.S. will continue to diverge. Like you, Lisa, I think divergence is a really important theme for the next 12 months. Is there a limit? Sure, there's a limit at some point, but we're not there yet. And the worst thing is to sacrifice U.S. growth in order to get lower rates. That would be the U.S. is the only engine of global growth right now. So you do not want to sacrifice the only engine of global growth. What you do want to happen is both for China and for Europe to get the act together and to transition to healthier and higher growth.
I have to wonder also how much this pushes central banks around the world to keep investing in gold and try to diversify away from the dollar, because at some point there has to be some anger or at least a feeling of frustration that everybody else is at the whims of the United States in terms of whatever kind of fiscal situation they want to implement, and that the fiscal dominance allows them to do that. How much do you see that kind of trend in gold, in other asset classes really continuing as people look toward a day that maybe could be a different regime with respect to the dollar?
So this trend, which we have seen now for a solid 12 months of trying to diverse away from both the dollar as a reserve currency, and importantly, looking to diverse away from the dollar system as a payment system. And I worry much more about the second than the first. The trend is there. And for the reasons you've cited, on the currency side, at the margin, and I want to stress it is at the margin, people are looking to diverse away from the dollar into gold. The payment system is a reaction to the worry about weaponization of investment sanctions and trade. So that is ongoing, and we have to keep an eye on it. Now, we're not anywhere near critical mass. There is nothing to replace the dollar at the center of the system. There is nothing to replace the dollar payment system. However, you don't want alternatives as clunky and as inefficient as they are to gain momentum.
Which is why we're seeing the dollar depreciate against gold, depreciate against something like Bitcoin. But I think we have to take a step back and recognize what it's not doing against other currencies. We're facing the prospect of an 8 consecutive week of strength for the US dollar, for dollar index, for DXY. Mohammed, the why is because the data in America has been pretty decent, and we're rethinking the Fed's path. Matt Lazzetti of Deutsche Bank had this to say in his outlook: growth is too fast, inflation is too furious for Fed cuts. Our baseline sees a 25 basis point cut in December, calls it a close call, goes on to say after that we expect an extended pause which keeps the Fed funds rate above 4% into 2026. Is that your base case too?
So my base case is they cut by 25. When they come to their next meeting, they'll have clarity on 3 things that will impact how they see the economy going. They'll have clarity on tariffs, they'll have clarity on immigration, and they'll have clarity on where the budget is going. And they'll build up that clarity as they go into the year. And that is what's going to determine whether they do more or not. They're going to see how these 3 things. John, these fundamentally impact. First, tariffs will impact price behavior. You see this in the UK. Companies now have gotten much more used to passing on any increased costs. So in the case of the UK, the supermarkets have come out and said, you know what, the higher national insurance contributions, we're going to pass on that to prices. And demand here is not as strong in the US as it is in the US. So tariffs will have an impact on pricing behavior by companies. Immigration will have impact on the labor market. And of course, what they decide on taxes in particular, which will come ahead of what they do on spending, where they're looking to cut spending, will have an impact on issuance. So the Fed is going to have to step back and look at these three things and then decide how they fit into this big puzzle.
Let's finish on that word clarity. They'll have clarity on tariffs. They might have clarity on what the approach might be, how big the tariffs will be. They may not have clarity on the effects. And this is something you touched on earlier this week when you talked about things like trade flows, corporate pricing, demand-supply elasticities. How long does it take to get clarity on the effect of those tariffs?
Yeah, and that list goes on, John. Game theoretics, statecraft. I mean, it is a very complex issue, and the media has tended to simplify it, oversimplify it. No, they'll need time, but they'll have a clarity on how serious is the direction of travel. And that's going to be important in how they think about what policy rates should do.
Mohammed, we appreciate your time. We're lucky to catch up with you, sir. Thank you. Mohammed Al-Erin of Queen's College, Cambridge, on the latest in the United States and beyond. We'll talk more about Europe a little bit later this morning. We'll catch up with an ECB Governing Council member in about 15 minutes' time. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Large parts of the Pacific Northwest are without power after a major storm moved through Northern California and Washington. A bomb cyclone has killed at least 2 people and led to widespread flash flooding and rock slides. A flood watch is in effect into Saturday for areas north of San Francisco, with dozens of flights canceled. Conditions are expected to continue into the weekend, with another 6 to 12 inches of rainfall expected. Meanwhile, U.S. Securities and Exchange Commission Chair Gary Gensler plans to step down on January 20th. President-elect Donald Trump had vowed to fire Gensler, who was tough on crypto and other markets. Trump can immediately choose a replacement for the position. And baseball's biggest stars have been crowned. Yankees slugger Aaron Judge and Dodgers phenom Shohei Ohtani were awarded MVP once again. For Ohtani, it's his 3rd MVP in 4 years after he became the first 50-50 player in history and helped the Dodgers win the World Series. He's now the 12th player ever to win the award 3 times. For Judge, it's his 2nd time winning the award, leading the majors in most hitting categories this season, including home runs and RBIs. Both players were voted for the awards unanimously. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in 30 minutes. Up next on the program, the bond market taking center stage.
What is the binding constraint for Trump to be able to enact his agenda? And I think it is a move on the long end of the curve, where we would be seeing kind of possible concerns of a second wave of inflation.
That conversation up next, live from New York. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Big rally in the European bond market this morning, down 11 basis points at the front end of the German curve off the back of weaker than expected data. Yields lower stateside by 3 basis points to about 439. That differential pushes through foreign exchange, weaker euro, stronger dollar, euro dollar about 104. Under surveillance this morning, the bond market taking center stage.
What is the binding constraint for Trump to be able to enact his agenda? And I think it is a move on the long end of the curve, where we would be seeing kind of possible concerns of a second wave of inflation. Bringing up the cost of government debt would be probably the thing that would cause Donald Trump to pull back on the reins and tell his Commerce Secretary, tell his Treasury Secretary to do the same. When Trump 2.0, I think the bond market takes center stage, where Trump 1.0, it was the equity markets.
So here's the latest this morning. Republicans preparing to push Donald Trump's economic agenda through Congress, potentially adding trillions to America's debt pile and pushing the Treasury market to the top of the White House's scorecard. Maya McGuinness of the Committee for a Responsible Federal Budget writing, with the national debt approaching record levels and interest costs exploding, lawmakers will need to consider substantial spending cuts and revenue increases to put the national debt on a more sustainable path. Maya's with us now for more. And Maya, you've got a note that's music to the ears, I think, of the Department of Government Efficiency. You say there is $700 billion of easy deficit reduction. Help us find it. Where is it?